economics of the Pacific Rim, do you buy the idea of a major commodity swing to a commodity supercycle?
Well, one of the things that worries me was that, at least in the short term, the statistics showed from the Chinese import statistics that they actually reduced the unit volume of their imports of a lot of their commodities in April. And so they'll have to jump back into the market, maybe already are in May. And there's no sign with infrastructure spending there still strong and ramped up in the States that a lot of these commodities are going to continue to go up unless there's some change in policy. And that goes for agricultural goods too.
You know, I look, John, at where we are, and all it comes down to is a linkage of all this financial dynamics back to GDP adjustments. Do you assume we will see adjustments in GDP as we try to gauge and game how we come out of this pandemic?
Do you mean by revisions of GDP?
Revisions to GDP, and maybe, you know, we take a little bit off the optimism that was there even 10 days ago.
I don't know about GDP. We could see some weakness in some components in the second quarter due to the shortages, and also due to perhaps a slowdown in some of the sort of office construction, that sort of thing. And maybe inventories will fall quite a bit. But no, I don't see a lot of revisions there. We could see some pretty big revisions in the non-farm payroll data. That's very possible going forward.
Just getting the NFIB report, Tom, for small businesses, and it really echoes a lot of the conversations that we've been having over the last several weeks. A record number of small businesses can't find the workers. Now, the conversation we've had over the last week, John Vale, is whether there is a supply-side issue. Answer that, for most people, is yes. What's driving it in your mind, John? What's the dominant factor, the dominant concern for you?
Well, I think it is a mixture of all the things you hear out there, including the incentives that people have to not work. That's definitely one of them. But we have to remember that the Fed officials who didn't speak yesterday sort of dismissed the number. They always say that they only look at 1 month, that they don't look at 1 month's number. And they also said they look at quite a few different numbers. And as we all know, like the NFIB numbers this morning and many others, the other labor data is showing very, very tight labor market, even if it is somewhat artificial. And we have McDonald's workers threatening to strike for higher wages. It's really quite an interesting situation these days with various factors affecting both prices and the labor market.
John, when we catch up with the White House a little bit later, I think there's an important question to ask. And Tim Dewey, an economist, asked this question out on Twitter yesterday, whether the supply response that we had, or rather the fiscal response, the monetary policy response we had over the last year, was predominantly for persistently weaker demand. And whether what we have right now is a supply side issue, and the current setup of policy, both on fiscal and monetary policy, is not calibrated appropriately for the moment we're in. Do you agree with that?
Well, there are a lot of factors that are different this time from before. I mean, there is some structural changes in the labor market. There's some major troubles on the supply side from accidents. As we know, that they run from semiconductors to the Suez Canal. And maybe those are transitory, but a lot of people, including purchasing managers and CFOs, it's going to be hard for them not to remember this situation and not to have some sort of inflationary psychology built in. There's a massive amount of fiscal and monetary policy stimulus that's going on, and they're sort of playing worried about the last war and the taper tantrums. And so far they're doing okay, and bond yields are under control. But they're going to have to be more and more careful as they go forward.
Hey, John, we've got to leave it there. It's got to catch up. John Vale there, Nikko Asset Management Chief Global Strategist. It has been too long, John. Thank you. In your equity market, down 1.4% on the NASDAQ 100, off by 185 points. Big tech in America getting hammered yesterday, Tom, and getting punched a little bit this morning,
listen
too.
To you, hammered the Pharaoh.
Can I say hammered?
Okay, come on.
Can I say hammered?
Look, folks, this drives me nuts, and John knows it. He's busting my chops. Tech craters. Tech is just crushed. No, it's not. Correction, normal index, Dow, SPX, 10%. Tech is a little more because it's more volatile, and you look at the standard deviations, and yes, John, as you mentioned, and I just looked at it, Apple, like Amazon, is outside a 2 standard deviation move. Yeah, I get it, but we're not trying to sell internet sites here. Tech didn't crater, it's just finally pulled back.
It's a 5% move off the recent highs. I knew that would wind you up. Here's the take from Costanegra at Goldman Sachs, the quote that you mentioned yesterday. Their commitment to growth is startling. They account for 22% of the total S&P 500 capex and R&D and sport a growth investment ratio of 64% versus 11% for the typical stock. Low rates support their premium valuations. That was David Costin on the handful of names that make up the bulk of the S&P 500. And it's the low rates components that we're starting to question, isn't it? That's what this inflation conversation's all about. Does inflation start to take off? Does it test the Fed's resolve? And does it really start to undermine the premium valuations of some of the big tech names out there?
So we've been dying for inflation. Every economist you and I know is begging that we get above a 2% level. John Taylor at Stanford has been hugely articulate on that. Fine, I get it. We may be wrong, and it may be a redux of the 1960s, John, but that has happened time after time after time, and it hasn't worked out. John, to go back to Costin's brilliant note, which looks not at the revenue frenzy that everybody looks at, folks, it looks at investment, cash flow, a near $250 billion of investment by 5 tech leaders in 12 months. The key phrase there is not $250 billion, $232 billion. The key thing there, John, is 12 months.
I love how fired you up are this morning.
I'm fired.
I'm just going to press buttons for the next 3 hours. Look,
I'm
with you, Tom. Too much attention paid to the equity market. I mentioned this 10 minutes ago. Not enough to the credit issue that came from Amazon. Just let me finish here. That issue from Amazon yesterday was just unreal. To see a company, a corporate institution, a tech company come to market and issue debt, Tom, at 10 basis points over treasuries on a 2-year. I think it was 95 over a 40-year. It's just incredible.
Yeah, Matt Brill killed that for us. Some Invesco as well. John, I'm fired up because Fulham was relegated.
You upset about that?
I mean, come on. Fulham was relegated.
I thought you were a North London guy.
I am a North London guy, but Fulham relegated is like un-American.
Okay, well, they are relegated, and hopefully they'll come back soon.
Where's Fulham?
Coming up in the next hour, Jared Bernstein, member of the White House Council of Economic Advisors.
The farthest south
you just go west, Tom.
The Ferris
wheel.
No,
you go west. It's
the
west,
farthest
it's not south.
West?
It's west.
That's where the airport is, right?
Go south to Crystal Palace. West is Fulham.
Crystal Palace.
Fulham, QPR, Chelsea.
I haven't been south of Claridge's.
I'm aware of that. I've done London with you. From New York City this morning, good morning. This is Bloomberg.
Good morning, everyone.
With the First Word News, I'm Ritika Gupta. More fallout from the shutdown of North America's largest petroleum pipeline. Gas stations along the East Coast are starting to run out of fuel. Colonial Pipeline says it expects to substantially restore service by the weekend. That may not come fast enough to avert immediate shortages in the southeastern U.S. That showdown over Jerusalem has turned into one of the most intense confrontations in years between Israel and the Palestinians. Militants in the Hamas-ruled Gaza Strip fired rockets into southern Israel overnight, and Israeli aircraft responded by pounding their facilities. Israel also ordered troop reinforcements, and reserve forces have now been called up. The latest economic report from China is adding to global inflation concerns. The producer price index rose 6.8% last month from a year earlier. That's the fastest pace in 3.5 years. The index measures inflation at the wholesale level. It was driven by rapid gains in commodity prices. And Bloomberg has learned that Ginkgo Bioworks has agreed to go public in a $17.5 billion reverse merger. The company will merge with a blank check firm backed by investor Harry Sloan. Ginkgo uses technology to program cells for a potentially wide variety of uses. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
you don't want to be preemptive. You also don't want to be so reactive that you're late. And that we have the tools to deal with these inflationary issues, but when you use them late, they can have a jarring effect. So I think that the challenge for us is to find the balance.
There is a hawk of the Federal Reserve. His name is Robert Kaplan, the Dallas Fed president from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz is out of the building. She'll be back with us next Monday. The price action shaping up as follows. Down 31 on the S&P. We're negative 0.75%. The Nasdaq is where the pain is. Down more than 1 percentage point again this morning. In the bond market, yields aren't doing much. 160.75 on 10s. We are basically unchanged on a US 10-year. Into the FX market we go. Euro dollar 121.65, advancing 0.3%. Some dollar weakness, some euro strength. And in the commodity market, for all the talk of a rip-roaring commodity market, this morning at least, crude is lower by 0.7%. Tom Keene, 64.45.
Yeah, 64.45. It really hasn't moved. Brent crude not through 70 at 67.85. That's sort of what I'm watching, is the global price of oil. Actually pretty stable, but you don't know that with the inflation numbers that are out there. And of course, the ultimate inflation, which is a gallon of gas. That's a tradition in America. Our tradition is to get smarter with Martin Schenker, Bloomberg editor-at-large, senior vice president, surveillance, gas prices as well. You and I are the only two in the building that remember the glory of a VW Rabbit diesel, and OPEC went up once, and we said, well, that was harsh, that's done, and then it went up a second time. Yeah. And that was a real wake-up call for this nation. L.A., thank you, ABC7 out in L.A., $4 a gallon, up 7 of the last 8 days, the highest level since November of 2019. When does inflation click in with politicians, particularly in the Senate, that are hardwired to a gallon of gas?
Well, it's going to come if this continues. I mean, while Jerome Powell says this is transitory, for the people actually opening their wallets to pay $4 a gallon for gasoline, it's not transitory at all.
It's not, he said it twice, transitory. John, say transitory.
Transitory. You want 3 drinks this morning? Marty, you make a really important point ahead of these talks tomorrow. Is that going to be the popular narrative across this country, even if it's not the popular narrative on Wall Street right now, because of the Federal Reserve saying it's transitory?
Yeah, I mean, I think that's true. One interesting thing that's going to happen tomorrow is Joe Biden meeting with the leadership of the GOP on the same day the GOP is going to probably oust Liz Cheney.
Is it a photo shoot? Come on, this is the second day. You and Farrell are talking this up big. They're going to waltz in, they're going to sit on the couches, they're going to do a photo shoot, and then?
And then we're going to see just how effective Joe Biden is as a negotiator and conciliator. I mean, he has sold himself, as I said yesterday, as being able to bring together the country and the politicians, and we're going to see whether he can do it.
Well, let's see where Republican leadership are right now, Marty, going into these talks. We've got $2.25 trillion plans on one side and something in and around $600 billion on the other side. When you hear from Republican leadership, they will say it's a negotiation. We're willing to come up. Come up by how much?
Well, probably not very much at all. But if, you know, the key person to watch here is Joe Biden. If he really wants to get an infrastructure bill through, he can probably do it. But he's going to have to reckon with the progressive wing of his own party if he gives in to the Republicans' desire for a much smaller infrastructure bill.
And the bigger fight right now, Tom, is not over size, it's over composition. Still, what is infrastructure? What is core infrastructure? That, no doubt, will be the debate this coming Wednesday.
Okay, we're going to get infrastructure done, and then it's the social message, frankly, to the election. What is the negotiating power of the liberals with their president right now?
Well, it seems to be on the wane, actually, because, you know, Joe Biden has met with Joe Manchin in the White House yesterday, and he is obviously trying to win over the moderate wing at the expense of the progressives.
Well, I don't have the math in front of me. Maybe we can pull a rabbit out of the hat in the control room. Connor Lamb, Northwestern Pittsburgh, 49.XX%, won by the opponent at 49.YY%. I mean, these are razor-thin elections. They've got the power in the Oval Office tomorrow, right?
They do. They do. And, you know, it strikes me that Joe Biden has finally realized that the midterm elections are now an issue he has to think about.
And John, I sense that this weekend. I sense just sort of, it's like when, John, I don't know, I mean, John, I know you know this is someone like Admiral Banks or whatever in the weather vane shifts in Mary Poppins.
Yeah.
You know when that happens?
Yeah, I think I recall that.
And everybody
movie,
talks British like you.
Yeah, thanks
that's
for
when.
that. Was that a good London accent in that movie?
I think Dick Van Dyke nailed it.
Was it? I think Dick Van Dyke nailed it too.
Absolutely nailed it.
Before we let Marty run, Marty, what we've seen over the last week or so, North Dakota joining Arkansas, South Carolina, Montana. The list of these states is piling up, and those states are removing these additional unemployment benefits that were approved at the federal level in the past year. Marty, just walk me through this, how this is stacking up in D.C. and what this fight looks like.
Well, it's interesting that Joe Biden came out yesterday and said, look, if you don't accept a job and you're taking unemployment benefits, you're going to lose them. Which it speaks to the point I just made about thinking about the midterm elections. Each state, many of them Republican, are going to consider whether or not they should continue these extra benefits with the labor shortage and the whole narrative that getting paid to stay at home is not tenable.
Marty Schenker, Bloomberg editor at large. Tom, we've had a lot of pushback on that argument. And even if you think that decision is underpinned by weak or bad, poor economics, it will have economic consequences. What the consequences look like over the next couple of months, I think will be fascinating.
Well, it'll be interesting as well to see who joins Kaplan. I mean, Kaplan's out there. Let's be clear. He is a really serious academic with major chops, but he represents a financial Wall Street system, John. It'll be interesting to see if anybody joins him.
Well, it's fascinating for the Federal Reserve because I think they'll struggle to make the argument that we have a demand-side problem. Right now, we have a supply-side issue.
They need more data.
I think we've got the data in front of us, Tom. It's pretty clear at this point we don't have a demand-side problem, isn't it?
Yes, that's correct. But they're going to say they need more data. Can I mention on Mary Poppins, John? We get wonderful things mailed in from time to time. I got a wonderful note from Karen Duttras a bunch of years ago. You don't know who Karen Duttras is, do you?
No, so carry on.
She was the little girl in Mary Poppins, and she watched us every single day, listened to Bloomberg on the economy of that. And, John, to be from Marty and my generation, to have someone like Karen Duttras send in something and say hello was just fabulous.
Okay. I have no idea where you're going with this morning.
It's just great.
I'm
in a very sentimental Mary Poppins
mood. Is this connected to the labour market somehow? On the
know.
childcare issue, just to wrap things up, Tom, on the childcare issue, it was pretty evident in the data on Friday that the female participation rate rolled over.
Yeah.
And a lot of people are bringing up the childcare issue. The Democrats are trying to insert that in the infrastructure proposal. And I think that's where there's going to be a bit of tension.
Yeah, I agree.
Tension there tomorrow. I think Mohammed Al-Erin out in the last 24 hours or so writing about this, that this was a core example of a childcare problem in America.
And John,
that needs to be addressed.
I mentioned it yesterday, and I got a lot of pushback. People are saying this is not a U.S. way. We're not going to be like France. We're not going to be like Netherlands. We're not going to have a governess like the little girl in Mary Poppins.
It is very
nailed that.
Political right now. Coming up, Michelle Meyer, Bank of America Securities Head of U.S. Economics. Equity futures down 0.75% on the S&P from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
What a fascinating market. Live from New York City for our audience worldwide. This is Bloomberg Surveillance, and here's your price action this Tuesday. Equity futures pulling back 33. On the S&P, we're down by 0.8%. The Nasdaq 100, with its worst day since the middle of March, we add to that move. We take off more weight from the Nasdaq. The Nasdaq 100 down 172 and off by 1.29%. As you well know, a third, almost 30% of the Nasdaq 100 comes from three names. So switch up the board. This is what it looks like at a pre-market. Apple, Amazon, Microsoft. Apple and Amazon between 8 and 11% from the recent highs. There's been a real drawdown there, despite the fact that we had fantastic earnings. And after those earnings were delivered, we all asked on this program, does it validate current valuations or justify further gains? It's the wrong question. We've pulled back, and pulled back big time. Amazon this morning down another 1.4, Apple down by 1.85, Microsoft adding to the move lower at 244 and off by 1.28%. A lot of people taking a move in tech and then saying we must be facing some inflation fears and then plugging that back in. But yesterday in the bond market, I didn't see any manifestation of some bond market fear around inflation. Saw a sort of nudge higher on a 10-year nominal yield, a nudge higher in break-evens. Your 10-year right now unchanged at 160.22. Some of it, Tom, just doesn't stack up. This argument that's all about inflation fear, because I don't see that in the bond market. I just see a bit of a tech rout, a bit of a tech pullback.
And John, I love how you say drawdown. That's a very technical term, folks, for from the top of the pricing down to where you are now. It's something used in the hedge fund world, John. And the drawdown of Amazon and Apple's two standard deviations, and you don't see that deviation move in the fixed income space.
No, you don't. It's a real move in the equity market. I think we both acknowledge that. But in the bond market, we topped out a nominal yield at about 174 the end of March. Right now we're at 160.39. Yes, break-evens have carried on breaking out. That trend's been there in place for the last 9, 10, 11, 12 months. I'll show the chart a little bit later on the program.
Right.
When you look at break-evens though, Tom, what are we looking at here? We're looking at the difference between the real and the nominal. And what influences the real? Do you know who buys tips? The Federal Reserve buys tips too.
Yeah,
have you ever given that some thought? How much signal is actually there present in the bond market when we're talking about all of this stuff?
I think it's a stew, John. I think it's a stew after the shock of jobs, waiting for more data. And you know, we're going to get to Michelle Meyer here in a moment, and we'll have that. Michelle Meyer's with us now with Bank of America Securities. We're also waiting for the Queen to make her entrance in London for the Queen's speech. That could happen at any moment. We'll show you some images of that, and on Bloomberg Radio, of course, describe it as well. It is a very much adjusted Queen's speech. Is also our speech with Michelle Meyer is always adjusted off the data. Michelle, you and Ethan Harris and the team have picked up the pieces off of Friday. How did the jobs report on Friday affect your view of Wednesday inflation and this coming Friday retail?
So I think, one of the clear takeaways from the jobs report is that there is, at the moment, some real wage pressure. So overall wages were up 0.7%. And when you dig into the details, you saw some pretty remarkable increases in wages in categories like transportation and warehousing, retail, trade, leisure, and hospitality. All sectors that should be seeing a real boom in terms of demand and hiring. And there's obviously some friction there where there's a whole lot of demand for workers, but there isn't enough of a supply at the moment. And that's creating this big upward pressure in wages. And that does set up for some greater price pressure in the economy, at least temporarily.
Do you think it's worth talking about the payrolls report from Friday? Too much, Michelle? Is there any signal in it for you? Is it worth focusing on?
Yeah, it is worth focusing on. It's, look, it's one report as always, but it is a report that is comprehensive. It tells us about the entire economy, where there is demand, and now also a bit more information around where there's supply, which you can glean from looking at the wage data. So look, it's not perfect. There might be some seasonal quirks. There might be some measurement issues. Right. We'll have to see what comes out more from other labor market indicators, but it is important for sure.
We've got a great analog now, John, of what we're all facing in our real world of economic data, and that is the traditional walk from the green leather House of Commons over to the red leather House of Lords. They're in a pandemic, John, and it really speaks to everything we're talking about of restaurants half full, retail barely going, and the huge disappointment Friday. I mean, you look at 74 people watching a speech, and that speaks volumes about the Western world's future.
Any excuse to make this happen. Should we explain what's going on?
No, I don't think so. It looks like a Liverpool bar after they've lost to Man U.
It's a little bit more sophisticated than that, Tom. Michelle, stay close, sit tight. We're just going to spend 60 seconds doing this. The Queen arrives in the House of Lords to reopen Parliament officially. Tom, escorted by Prince Charles. What will happen is then members of the House of Commons will come in. They'll all fill out that chamber, socially distanced, very different to what we've seen in years gone by. And then, as you've pointed out, Tom, essentially the Queen reads a press release from the government, which is just a list of priorities for this Parliament. And I think one of the interesting priorities is going to be the removal of this fixed-term Parliament Act, which will actually enable the government to call early elections. And I think that would be the thing worth focusing on, Tom, maybe in the next 12 months, 18 months, 2 years off the back of this speech.
Well, let's not waste time here on that when we've got Michelle Meyer with us. But, John, I just think it's a great analog for what everybody in the world's facing with a pandemic and trying to get beyond it. As we saw with Pfizer now, vaccinations down to 12-year-olds last night.
I'd love to believe that's why you introduced those pictures,
it is.
Tom. Let's move on.
Is.
Michelle, thank you for your patience.
Michelle did a tour of Downton Abbey once.
We were always going to have to cut into program to do that for Tom. I've covered this more with Tom than I have ever in my life. I've seen this more times with Tom than I have alone. I never watch this. Michelle, it's great to have you with us. I want to talk about the removal of UI, unemployment insurance, the additional benefits that were offered by this government that we've seen in North Dakota. We've now seen in Arkansas. I believe we've seen in South Carolina and Montana as well. They're political decisions. I don't expect you to weigh in on the politics. What do you think the economic consequences of those political decisions will be?
Well, look, we're creating some really interesting case studies. There's a big debate over whether or not the enhanced unemployment benefits are discouraging or delaying the re-entrance into the workforce. And these 4 states have now expired those programs. So in the next few months, we'll see, do you have, as a result of that, labor supply coming back in? Do you have an easier search process? Do you have some cooling of wage pressures in those states? So looking at the regional data, I think is going to be extremely important in the next few months to try to determine what's happening in those states.
Have you adjusted? Have you adjusted your GDP call, Michelle? Have you adjusted the boom economy 8, 9, 10%, and then whatever the stream is off of that?
We haven't. So we are still very much on track for 10% growth in the second quarter on the annualized basis. And, when you do the math and you kind of add up the quarterly numbers, a lot of that strength in Q2 is off of the base effect from March. Because March was so extraordinary across a variety of indicators, you're starting at a very high level. So unless things were to really, decelerate or even decline over the next few months, you're setting up for a very strong second quarter, driven by consumer spending and supported by overall business investment as well.
Yeah, but what's your then what? Do you literally have to wait to see retail sales on Friday before you do the then what of Q3, Q4 into first quarter next year?
So the then what, yeah, I mean, obviously the incoming data matters. Retail sales is going to be important for April, but be mindful of the fact that it's a bit of a payback for March, because March was, again, just a blistering hot month for the economy. So there's some cooling from that. But as you look into Q3 and Q4, you have to think a lot more carefully about first the underlying trend into the economy in terms of demand. How long can demand remain at these levels? And a lot of that is driven by the consumer and how quickly they may be able to re-engage and draw down all of the excess savings that's out there. And second, the supply side of the economy, which increasingly has become important. And that's where I think the new focus is. You know, up until, last week or, certainly with the jobs report, everybody's just trying to figure out how much demand is there out there and not necessarily paying enough attention to, well, what are the supply constraints to allow the economy to continue to run?
Michelle, just a final question, and forgive me because it is on the demand side. You've got great access to card data at Bank of America. How much spending is being done in this country at the moment? Michelle, can you share some of that with us?
Sure. So what we saw throughout the month of April is some moderation in spend relative to the extraordinary increase in March. But when you take a step back and you look at the pace in card spending over, call it a 2-year period, to ignore the 2020 base effects, we're still running on a 2-year basis well above the pace that we had on a trend basis prior to COVID. So the consumer is still seeing spending in excess of what would be considered a normalized pace of spend.
Michelle Meyer on the latest data in America and the look forward as well. Bank of America Securities Head of US Economics. Tom, an interesting comment from Michelle there. We're making these political decisions at the moment in Arkansas, in South Carolina, North Dakota, Montana as well, about what is holding back labor supply, labor shortage, huge demand. Why can't we meet it? There will be economic consequences. Now, I don't think anyone who comes on this program believes they're the kind of case studies we want to see play out. But that's the kind of case study that's going to play out right now before our eyes over the next couple of months in this country. And if you see positive results in those states, if you see more hiring to meet the job openings, how many other states do you think will have to follow, and how much pressure builds on this government, this administration, as they push forward to try and do more?
In usual, the work's been done. The University of Chicago has done great work, which the New York Times had, I'm going to say, 8 months ago or so. And you can line up the ducks, John, and figure out the momentum, the reaction functions, as you will, is these states get better employment and have to have less unemployment benefits. They use Kentucky as the worst case, but you just, to your point, you wonder where the states are. Greg Valliere publishes moments ago that the stock gains that have been seen in this great bull market lead to massive surpluses, including California swinging from the worry of a $54 billion deficit to a $76 billion surplus. We've never seen a swing like that.
Just quickly, are we done with the House of Lords?
Oh, Lord no. Lord no.
We're not done.
Lord no. We're waiting. We got a camera up top looking for Lord O'Neill.
What more would you like?
I want to see if Lord O'Neill's there, Lord Desai, the rest of them.
Can you spot your friends in there, Tom?
No, you can't, because they're wearing the hair thing.
I'm not sure I've got any friends in there. Can you spot yours?
Yeah, here is the Queen of England.
That's where your friends are.
95 years old.
There we go. We're going to go out with this.
We should.
Respectfully.
Pay respect, John.
Respectfully. I'll pay my respects to the Queen of England, who is reopening Parliament in the United Kingdom this morning and laying out the Prime Minister and this government's priorities for this Parliament. Let's take a listen.
Government in Northern Ireland and address the legacy of the past. My government will introduce measures to increase the safety and security of its citizens. Legislation will increase sentences for the most serious and violent offenders and ensure the timely administration of justice. Proposals will be brought forward to address violence, including against women.
With the First Word News, I'm Ritika Gupta. President Biden says Russia has some responsibility to address that ransomware attack that crippled a giant fuel pipeline. The president stopped short of directly blaming the Kremlin, but he says there's evidence the hackers that they use software used in Russia. Meanwhile, some gas stations on the East Coast say they're running out of gasoline. Colonial Pipeline says it expects to substantially restore service by the weekend. The Biden administration is ramping up its response to the global semiconductor shortage. Commerce Secretary Gina Raimondo plans a summit with companies impacted by the shortfall. That includes the largest chip manufacturers and U.S. automakers. According to an invitation obtained by Bloomberg News, the meeting will be held May 20th. U.S. U.S. regulators have cleared the way for the Pfizer-BioNTech coronavirus vaccine to be used in younger teens. That paves the way for mass vaccination of children before the start of summer camps and the next school year. They could start getting the shots as soon as Thursday. And last year, China posted its slowest population growth in decades. There were 1.4 billion people in the country. The annual average growth of 0.5% in the past decade was the lowest since 1953. That has sharply reduced the size of the labor force. And Blackstone wants U.S. dealmakers back in the office full-time by June the 7th, as long as they are vaccinated. The world's largest alternative asset manager announced the move to staff yesterday. Financial firms have been preparing for an end to remote work since the earliest months of the COVID-19 pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
In a lot of places, eating indoors, going to a bar indoors, it's not the safest thing at all.
And in fact, it could quite lead to another super spreader event if there are people around who aren't vaccinated. So I think we're struggling a little bit with our, anxiety about, having people show that they're vaccinated. Hopefully that will dissipate and we'll be able to have more clear rules.
That was Joshua Sharfstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York City this morning, good morning, alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramowitz is out of the building. She'll be back with us next Monday. Equity futures down 35 on the S&P. We decline 0.8%. The NASDAQ 100 getting beaten up a little bit in yesterday's session. This morning on the NASDAQ 100 futures, we are down by 1.39%. Your yield is unchanged. It is steady and stable at 159.86 on 10s. In the FX market, euro dollar 121.56, and in the commodity market, we declined by 0.9% on crude. WTI with a 64 handle, $64 and about 30 cents. That's the price action. Let's bring you the latest data on the vaccination effort in this country. Your 7-day average in the past week, your daily average in the past week, 2.12 million, Tom.
Really?
That's been rolling over in the last month. You do wonder, as we start to get those emergency approvals for that drug to be used, that vaccine rather, to be used on the younger age cohort, whether that number starts to tick higher again.
Yeah, it's going to be interesting to see, and of course emotional as well. As we all look back to February of a year ago, we have our signposts along the way. John and I would suggest that last night was one of them, with Pfizer now available for the 12 to 15-year cohort. We need perspective. Dr. Adalja joins us from Johns Hopkins Center for Health Security, senior scholar. My basic take from my Ute, Dr. Adalja, this is all about pediatricians. Can the pediatricians get this done?
I definitely think pediatricians can get this done because pediatricians are used to giving children vaccines all the time. So as we've seen, vaccination rollout move away from mass vaccination centers to doctors' offices, to drugstores. I think that's going to be something that makes it really easy for children to get, and pediatricians are probably the best vaccinators they are. They are very good at reassuring children. They're very good at handling and storing vaccines. So I think this is going to go well.
And within that, and thank you for your optimism, but within that is the idea none of us would go in and tell our pediatrician, no, we're not doing tetanus. No, we're not doing diphtheria. How do we get to that belief with COVID?
Well, I think that people recognize the value of the COVID vaccines. They know that there are going to be some parents that are vaccine hesitant, that are on the fence, but many people want that age group of 12 to 15 vaccinated to be able to facilitate summer camps, to be able to facilitate extracurricular activities at schools, and to remove, one more obstacle that some school boards have put in the way of opening schools full time. So I do think that this is going to be something that you're going to see an initial demand, and then I think we'll get to that kind of point where we have to start talking to people about what the benefits of the vaccine are for their child and kind of weighing the risks and benefits in each individual child. But I think that you're going to see an initial surge of parents wanting to get their children vaccinated.
Doctor, you said a couple of interesting things there. One of them is that people recognize the value of the vaccine. Do you think we've done a good enough job in government, from the CDC, etc., to communicate the value of taking this vaccine, of receiving this vaccine?
Not completely, no. And I think we're only starting to get that way. The CDC guidance has been very cautious, little baby steps. It's been lagging what people have been doing. And people keep saying nothing changes when you get the vaccine. And that's not the message that's actually true. It's not the message that people want to hear. I think that in the early adopters, the people who get the vaccine first, those first groups of parents, they're going to understand that value. But when we get into the general population, you may find people saying, well, why should I get this vaccine? It's not really a value. I can't really do anything. And that's why we need the CDC to be more proactive and really push the envelope of what vaccinated people can do, because the virus treats you very differently if you're a vaccinated person. So other people should treat you differently because you're no longer a threat.
Do you think we've moved the goalpost just a little bit here over the last year? At the beginning, a lot of people felt like that it was about protecting, almost exclusively about protecting the most vulnerable in society. If the overwhelming majority of that group is now being vaccinated, Doctor, there are some people asking the question, why are we still doing all of this?
I think that's a great question, because that's what flattening the curve was all about. It was trying to keep cases below hospital capacity. And that's exactly what the prioritization scheme did. It vaccinated nursing home residents, high-risk community dwelling people, those who made up the majority of hospitalized patients. And now if you walk through a hospital, it's nothing like it was just in January 2021, because so many of those people have been vaccinated. So I think we have been successful at taming this virus. We've been successful at defanging it and removing the of it cause hospitalization, serious deaths, serious cases or deaths at the rate that it could in the past.
I look at the cases rolling over. When does a pro like you say we're all clear on cases? Is it a 20,000 statistic? Is it 5,000? Or do we literally need to go to zero?
It's impossible to go to zero. This is not a virus that can be eliminated or eradicated. I don't know where that number is, whether it's 20,000, whether it's 10,000. To me, it's always been about removing the ability of this virus to threaten hospitals, and we've largely done that in the United States. So to me, I think the pandemic's acute phase is over. Now this is sort of mopping up, trying to decide what level can we live with, what level of disruption can people have when they've got cases and exposures. I think we need to get as high a vaccination percentage as we can, but I do think right now we've done the primary objective was to protect our hospitals from ever being inundated with COVID-19 patients the way they were in the past.
Doctor, in your opinion, at this stage then, do you think it would be more effective to lead with a carrot and not a stick?
I think it's always better to lead with the carrot and not a stick from the very beginning. We know that from many other infectious diseases that abstinence-only approaches with HIV, sexually transmitted infections, injection drug use, it doesn't work. We have to do harm reduction. We have to tell people these are the risks. This is a toolkit that you have that you can use to decrease that risk, knowing you can't get the risk to zero. I think if we would have done that from the beginning, we would have avoided all the acrimony over masks and politicization that happened. And I think we definitely need to do it now as we're moving into this next phase.
Doctor, appreciate your honesty, perspective and clarity. As always, Dr. Amish Adalja there, Johns Hopkins Center for Health Security, senior scholar. That right there is the conundrum at the moment, Tom, and many people are scratching their heads about it. In the last 12 months, the overwhelming goal, almost exclusively, was to protect the most vulnerable in society. You heard the doctor just then. We've largely achieved a lot of that in this country and elsewhere too, which begs the question for many people, why are we still doing many of these things that we're still doing?
Yeah, it's an evolution. I'm seeing it on the streets of New York, John. And, you know, I went deep south yesterday. I got down to 72nd Street. And, you know, I'm seeing an evolution on face masks. Even I'm doing it myself. You know, you just don't put it on like you used to put it on. But, John, this 12 to 15-year thing is going to be fascinating.
Yeah.
There's got to be a point where the schools say, look, this is a tetanus equivalent. If you don't have tetanus, you don't come to school. If you don't have COVID, you don't come to school. I mean, I don't know when that happens, but to me, it's a no-brainer. It's got to happen.
It does change things, though. We're now saying that we can't reopen the schools unless the kids have been vaccinated, even though the teachers may well have been.
Yeah, I agree.
I thought we spent the last 12 months saying that this doesn't really harm children unless they have underlying conditions.
What are they doing in London with schools?
No children, so I'm not sure what's happening in London right now. I do understand that in the next week, Tom, things are going to reopen even more.
They're going to reopen even more. Are we going to see people when Burnley plays because they weren't relegated? Are we going to see people now in the stands?
Not yet, but there's going to be a bigger drive, a bigger push to reopen things further. Much, much bigger push. And Tom, we have moved the goalpost. Let's be clear about that, which is why many people in society are incredibly frustrated with what's going on.
Yeah.
Was it always about getting to 70, 80% vaccinated in this country?
Oh, no, we're nowhere near that. No, I think the goal is 60%.
It's the goal now to get 70% at least to have one shot.
On first blush, I think that's difficult. Look at the market. Tech is crushed. It's cratered.
1% lower on the S&P. Coming up, a view on the equity market with Michael Purvis of Tallback and from New York.
God, I'm triple
This is Bloomberg.
all cash.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
Feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
People were too optimistic. I think people, saw the big growth in demand and they said, supply is going to spool up to meet it, and it didn't.
Everyone's ready, and I think properly should be strapped in for what could be a very wild summer.
The party on the issuance side has stopped a little bit, but the party on the demand side is still there.
The data is important, but it's really the data not right now. It's going to be the data in August, September, when we say that the reopening is behind us.
This summer is going to be huge. People are going to spend, and the bounce back in oil demand is probably going to be significantly more than people have been expecting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The NASDAQ hammered from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Lisa Abramowitz is away all week. Tom, I did that just for you. I did that just for you.
You did that just for me, and I'm sorry, folks. We are hammered, we are crushed, we are cratered, if I can spell it right here. No, we're not. All we've had is a big surge, and in some ways, like Kathy Wood's fund, we've come back to the mean trend there, John. I misspelled cratered there, folks. That's my error, not Riley's in the control room. That's completely my fault. But John, I really want to point out the VIX is one indication. That volatility index on the SPX, our guest coming up here in moments will be optimistic on that. It's hammered from 16.90 on a moving average basis out to a spot 21.57. John, the world is coming to an end.
5% move off the highs on a NASDAQ 100. We're down another 1.28%, so you can add to that move. Tom, when we look at the single names, though, and we did that a little bit earlier this morning, so let's repeat that exercise. Amazon about 8% move off the high at the end of April. We add to that move to the downside this morning, 11% for Apple off the high that we saw back in January. We've seen some big moves, Tom. Let's be clear about that, the single name level. And these are big companies with big weightings.
Pros look, folks, at standard deviation, a statistical mask there. And yes, we are through 2 standard deviations in some of these big names. I know you mentioned earlier David Kostin's wonderful note reaffirming tech's ability to earn money with or without inflation and such. John, we haven't had a pullback. We've got a bull market this year. Ben Laidler at eToro's right. It's been a double-digit return. It looks like a double-digit 2021. John, you're allowed to take a break.
Credit market's still buoyant too. Last week, I think we saw about 570 on CCC yields, 5.7%, just north of that at one point last week. And then yesterday, what did we see from Amazon? We mentioned this several times in a previous hour. They were issuing 40-year debt at about 95 basis points over the Treasury. They were issuing 2-year debt, 10 basis points over the equivalent Treasury yield. Tom, that's unreal. 10 basis points over Treasuries on 2-year debt.
And I believe it's AA plus, and it's on its way to AAA. Who knows? And that parallels with Caroline Hyde's important interview today with IBM later this morning, John, where they've gone from AAA to an A- rating. IBM is not going to get the yield that Amazon got.
We'll take that on TV and on radio a little bit later on Bloomberg. The IBM CEO sitting down with Caroline Hyde. Your price action looks like this: 41.52 on the S&P 500. We decline 31 points and down 3/4 of 1%. Yields 160.39. Should we sit on this, Tom? 160.39 on the nominal yield. Where's the real yield right now? About negative 90 basis points.
Well, the 5-year yield down to a new big negative low. I think that's just as important as the off-quoted 10-year yield. But, I want you to bring in Michael, John. You do it better than me. But, for Michael Purvis, I'm sorry, it's cratered spelled correctly, not crated.
Let's bring in Michael now. Michael Purvis there of Tallback and Capital Advisors CEO.
There we go.
Michael, I'll leave it open. Bit of tension between Tom and myself this morning, shock horror. How would you characterize the move you've seen in the NASDAQ 100 and some of the individual components of it?
Well, it's, as a backdrop comment, we've been all sort of watching this breathless rally, over the last 12 months, over higher. And so on one hand, these kinds of consolidation type moves are sort of needed. What's a little bit interesting, though, about the NASDAQ move is that it was not especially technically overextended just now, certainly not relative to the broader market, the S&P 500. Also, if you think about, the earnings that came through with the big tech companies, those were generally really quite constructive. The equity risk premium for the NASDAQ was actually getting, coming into this week was actually in a pretty healthy space. It wasn't extraordinarily tight. There, and the whole. What's also interesting is that if you remember last year, you could do those overlay charts of the 10-year real interest rate with the Nasdaq outperformance, and it was sort of tick for tick all the way up into late summer, with that real decline in 10-year real interest rates, and now 10-year interest rates are falling again. And the textbook is not playing out from last year here. So it's a little bit interesting. You wonder whether, Bezos' shares and selling of some of his shares in Amazon the other day was a little bit of a sort of mark the top there. And you guys were just discussing some of the highs put in there. Look, I think it's an important. It's a very important part of the broader market. The what I call the NDX group, the big cap tech. I think it's also been a trade that's worked, even if it's been sort of out of fashion through this rotation. For the last several years, it's worked so hard, and sometimes things just sell off because they sell off. And look, we have had this breathless rally. I actually still continue to argue that this is sort of the quiet, broader backbone of the broader case for owning U.S. equities. These things are earnings machines. Sometimes the valuations get stretched there, but they'll probably.
And we've seen a correction in some of those big names. I'm just going to jump in, Mike, because you've mentioned a couple of themes there, and I want to sit on the theme around rates, because that's where some confusion is. We've got 10-year reals right now at negative 93 basis points almost, and that's been trending lower now for the best part of a month, 2 months. Yet what we've seen is the pain turn up in the NASDAQ more recently. Michael, your thoughts, just explain that a little bit more for our audience who have been told repeatedly over the last several months about this relationship between real yields and big tech.
Right. Well, it was interesting. Like as I was just discussing a year ago, the very low, the ever lower real 10-year interest rate sort of matched this this move higher in the Nasdaq outperformance, and at least certainly just yesterday, that's not sort of revealing itself there. The sort of the broader underpinnings for that relationship, come back to the fact that a year ago you were looking at just a very uncertain outlook for everything there, and these tech machines were able to sort of grind out earnings growth a lot. I do think part of this big bang on we've just seen on the NASDAQ is a little bit that comes back to that, hey, we've got the vaccine, we've got fiscal stimulus, we have inflation, so you want to be really it's almost inflation hedged, if you will, and Microsoft isn't really an inflation hedge, whereas cyclicals and industrials benefit more than that.
Michael, this goes to your research note where you talk about sustained risk on. Okay, I believe I want to be sustained risk on. How do you affect that? How do you construct any sense of portfolio or allocation around a phrase sustained risk on?
Right, and just to explain the sustained risk on, what I'm saying here is that this macro backdrop of 10-year Treasury interest rate, the nominal yields being very stable now after that big surge in yields we saw earlier this year, 10-year interest rates being very low, like we just discussed, the dollar getting back into its weakening position, there a high premium of implied volatility to realized volatility in the equity market. Those are all sort of very constructive, and of course the the growth that we're seeing, even if it's fits and starts like we saw with the employment report there. But in terms of portfolio construction, I am continuing to be very oriented towards the value part of the value and cyclical part of the market. I have overweights in big banks, I've got overweights in steel companies, those kinds of things. I think the growth is very palpable. At the same time, though, I do have a little bit of a barbell where I still have a weighting in some of the NASDAQ, but I'm using dips like we're seeing right now to sort of bolster that up a bit there. So again, I think right now the case for cyclicals and value is very, very strong. I would say small caps are a little bit more problematic, and I think it's very much case specific there. But at the index level, meaning the Russell 2000, I think that's a little bit challenged simply because some of the high flyers are that are in that index are just they're being sold here.
Well, it's the NASDAQ that's challenged this morning, and a Russell as well. Mike, good to catch up. Michael Purvis there of Toolback, and challenged on the NASDAQ, down by more than 1% in early trading on NASDAQ futures. Apple down another 2 percentage points in early trading. Tom, I know what you're saying, and for the most part, I agree with you. But when you look at what's happening with some of these major names that delivered blowout earnings in the last several weeks, this is another decline this morning on Apple.
Yeah, but I really take issue with this. The word is expected or expectation. And John, it's on both sides of the equal sign in the classic equity occasion. And you bought Apple back when it was, terrible, we're all going to die. And then you got the resurge out of the pandemic, and it's the now what. And I'll take the point. There's a real mystery to the now what of big tech coming out of this pandemic.
124.30 on Apple in the pre-market, just to go through some of the analyst ratings for you all out there. 33 buys, 10 holds, 1 sell, 12-month price target. On average, Tom, 157 from 124 right now. At the top end, we talked to Dan Ives of Wedbush recently, didn't we? 185 for Dan Ives over at Wedbush. He's looking for 185 from 124.
I mean, Costin didn't go down to individual securities, but as a bundled FANG, David Costin made very clear there's huge cash flow generation here. And really what it comes down to, John, is a responsible husbandry of that cash flow. And I go back again to whether you agree or not, the fact is that Amazon's spending $80 billion on R&D and CapEx. I can't get my head around that.
They're borrowing for what, Tom? 10 basis points over treasuries.
Exactly.
That's what they're borrowing for.
They're literally building out an empire, which is a different, you got to treat that differently.
We've got a great lineup over the next couple of hours. We'll catch up with Mr. Dudley, formerly of the New York Fed, after Mr. Druckenmiller publishes this in the Wall Street Journal this morning. The long-term risk from asset bubbles and fiscal dominance dwarf the short-term risk of putting the brakes on a booming economy in 22. Looking forward to hearing the Dudley take from Bloomberg Opinion a little bit later, and very shortly, in a couple of minutes' time, it's Jared Bernstein from the White House. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. More fallout from the shutdown of North America's largest petroleum pipeline. Gas stations along the East Coast are starting to run out of fuel. Colonial Pipeline says it expects to substantially restore service by the weekend. That may not come fast enough to avert immediate shortages in the southeastern U.S. That shutdown over Jerusalem has turned into one of the most intense confrontations in years between Israel and Palestinians. Militants in the Hamas-ruled Gaza Strip fired rockets into southern Israel overnight, and Israeli aircraft responded by pounding their facilities. Israel also ordered troop reinforcements, and reserve forces have now been called up. The latest economic report from China is adding to global inflation concerns. The producer price index rose 6.8% last month from a year earlier. That's the fastest pace in 3 years, 3.5 years even. The index measures inflation at the wholesale level. It was driven by rapid gains in those commodity prices. Ginkgo Bioworks has agreed to go public in a $17.5 billion reverse merger. The company will merge with a blank check firm backed by investor Harry Sloan. The transaction includes a $775 million private placement that includes Bill Gates' Cascade investment. Ginkgo uses technology to program cells for a potentially wide variety of uses. And L Brands reportedly will spin off Victoria's Secret rather than sell it. According to the New York Times, L Brands was split into 2 separate companies, Victoria's Secret and Bath and Body Works. The Times says the deal will close in August. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're moving in the right direction. So let's be clear. Our economic plan is working. I never said, and no serious analyst ever suggested, that climbing out of the deep, deep hole our economy was in would be simple, easy, immediate, or perfectly steady.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abrambis will be back with us next Monday. Here's the price action this Tuesday morning. Equity futures rolling over, down 0.75% on the S&P. We're negative 174 on the NASDAQ and moving deeper into negative territory, off by more than 1%. Your bond market is stable. It's unchanged on a 10-year at 160.39. And in the FX market, just a touch of dollar weakness, Tom. Euro strength, euro dollar, 121.64.
Really interesting here. The data really speaking volumes off the shock of the job economy report on Friday. Again, inflation tomorrow, retail sales on Friday. It is a wonderful time to move on from the jobs report and catch up with Jared Bernstein, member of the White House Council on Economic Advisors. Dr. Bernstein has been definitive on social economics with his work at the Center on Budget and Policy Priorities in EPI. Before that, an advisor to Vice President Biden, now holding court at the White House. Jared, thank you so much for joining us today. Jared, I want to go back to the arch-conservative fear. It has been there from the time of David Ricardo and John Stuart Mill. We will not grow our way out of our challenges. Everyone in the middle, everyone liberal, including Joe Stiglitz, a laureate, has battled this for years, including Solow at MIT, 1957. Describe right now this fear that we can't grow our way out of our challenges.
Well, that's certainly not a fear I share. And in fact, I think the administration's policies thus far are very much targeted at not just growing our way out of this, because that's always going to be just a part of the solution, but making sure that that growth is equitable, that it's reaching people it hasn't reached before. One of the touchstones of President Biden's economic policy will always be GDP growth, stock market growth, even lower unemployment by itself is not enough. It has to reach the middle class, it has to reach lower income people, and they need the bargaining clout so they can claim their fair share of the growth, which, by the way, was 6.4% in the first quarter, and the fingerprints of the rescue plan are all over that. Getting to the other side of the crisis begats the Building Back Better agenda, which is a much longer-term set of investments.
Jared, what does the Biden Morning in America look like?
You know, I think the way to think of that is kind of shifting from the American Rescue Plan to the Jobs and Family Plan. The Rescue Plan was always intended to do precisely what it's doing, get us to the other side of the crisis as quickly as possible by getting shots in arms, checks in pockets, and making sure families and businesses and child care providers are intact on the other side of the crisis. But simply getting back to where we were is wholly insufficient for this administration. There needs to be a deep 10-year set of investments embedded in the Jobs and Family Plan to make sure that what I described in my first answer to you occurs, which is that we pull along folks who've historically left behind by deep investments in education and opportunity, in neighborhoods that have been left behind, in clean energy, in manufacturing, and standing up a care sector for child care and elder care. Those are all keystones of the Jobs and Family Plans.
Montana, South Carolina, Arkansas, and now North Dakota. Jared, you'll be familiar with this story. They're pushing back against the additional UI, unemployment insurance. Have you spoken to the governors of those states?
I have not personally spoken to the governors, but
That's
there are
the president.
There are people within the administration. I don't know. I have a readout of precisely who, but I do know that yes, the president talks to governors all the time.
Do you think that's the wrong decision?
Yeah, I do think it's the wrong decision. I think the right decision is what the president talked about yesterday, which is a twofold: to make sure we take down any barriers that stand between people and getting back to work, with childcare being the most prominent, to make sure that the rules of the UI system are followed. If people are offered a suitable job, the rules say they need to take it. And suitable, by the way, means a job that enables them to go back to work safely and recognizes that people have child care obligations that they can't always meet. So helping to take down those barriers, getting folks back to work, and recognizing that the UI system is classic insurance for people who don't have income for work, and it's been a huge boon to unemployed Americans throughout this period.
If it's the wrong decision, let's stress test that. What will the consequences be this month and next month when these policies are introduced?
Yeah, that's a great question. So I think they're twofold. One is that you'll see people really experience a level of economic hardship that wouldn't have occurred if they'd maintained their enhanced benefits. And the other is that you're not going to see much difference between the labor market outcomes in these areas versus others. So if we dig into the data thus far, I should say thus far, because these things change month to month, we don't see a negative correlation between places where unemployment insurance replacement rates, meaning the extent to which it's replacing the wage, we don't see a negative correlation between replacement rates and labor market outcomes. So that would suggest that UI is not the problem. And we know that people are facing barriers to childcare, to school. We know there's concern about the virus out there. If you actually look at the vaccination rates among working age people, they're obviously a lot lower than the broader adult population.
Dr. Bernstein, you are eminently qualified to speak to those on the right and the left with your PhD in social welfare from Columbia. Folks, that is a history and a heritage that speaks of a long century. Dr. Bernstein, frame right now on child care the debate of a federal solution versus states' rights to decide what their child care would be. Where does that stand now, and where does President Biden want it to go?
Probably the best way to answer that question is to look at every other advanced economy and recognize that they have stood up an accessible and affordable child care sector. And in the vast majority of those economies, the labor force participation rate among caretakers, particularly women, is many percentage points higher than ours. This is not, a classical sort of federal state right thing. This is a classical missing markets problem. Even the most mainstream economics recognizes that when a market is missing, there's a role for the federal government to come in and fix that externality. And here the negative externality is a barrier to work for people who want to get into the labor market. So this is just a very simple solution to a market failure.
I look, Jared, at the solution to a market failure, and I look at the politics. You don't have to worry about 2022. Your boss does as well. How is the White House adapting economically to the reality of an election coming ever closer in 2022?
Yeah, that's an easy one. If you just watch the where the president and the vice president are going and listen to what they're saying, they are taking their message to the American people. And if you look at the American people's response.
Okay, I don't mean to interrupt, Jerry, but you've nailed it. How do they sell this to Republicans who support what you're talking about, yet the leadership that they have is dead set against it? How does that metric, that dialectic work?
Well, I think that, you don't have to sell things to people if they're things that people want and need. You just have to tell them about it. So I think it's less sell and more tell. Explain to constituents what you're trying to do. And what we found from the polling is that telling does not require selling when it's childcare, when it's safely reopening schools, when it's beating the vaccine, when it's providing people the resources they need to get to the other side of this crisis, and when it's making historic investments in the jobs and families plans in their lives and their opportunities. Now, what goes on in partisan circles in D.C., we have to show that out for what it is. But the president and vice president are keeping their heads down, meeting the needs of the American people on all sides of the aisle.
Well, the president will be meeting with the Big Four in the White House tomorrow. And Jared, we talked about childcare. Are you determined to make childcare and policies addressing childcare issues a part of a broader infrastructure package?
Unquestionably so. And in fact, if you look at the jobs plan and the families plan, you see that right at the heart of those plans. And I should be very clear about this. As I said before, I think sometimes this childcare story takes on a life of its own in the way that Tom was referring to otherwise. For us, it's providing an accessible and affordable path to get into the job market for caretakers who want to do so. Yep. Some will want to, others will not want to. But if you want to and you need to get back to work, it is not hard to find caretakers today who say, I can't get back to the job market because I can't find accessible, affordable care. It is a missing market, and we have to stand that market up, and that's what our plans do.
I'm not here to advocate for anyone's policies. You clearly are, Jared, and that's understandable in your position, sir. But when it comes to tomorrow, is that a red line for this administration? Childcare as part of a broader infrastructure package. Is that a red line?
Well, I'm not in a position of setting legislative red lines. I'm on the economics team, and I'm talking about the economic rationale.
Has the president communicated that to you?
Hold on. It is at the core of everything that the president has talked about from the campaign, by the way, until through the American Jobs and Families Plan.
Trying to gauge where the priorities are. Jared, understand that you can't negotiate on behalf of the president, but when you sit around with the president, from your understanding, is that still a core part of communications and negotiations with Republicans?
Very much so. And I think if you look again, I think I don't always like to cite the polls because I think you can pick and choose what you want. But on this issue, you can't find a poll that doesn't show a majority of people saying this is really important to us to be able to access an affordable child. If you actually look at the amount of income that a middle or a low income family has to pay for childcare, you're going to start to get into 10, 15, 20, 30% of their income in some cases. And that is simply unsustainable for working families. And that's why the president is targeting this issue.
Jared, and we appreciate your time to communicate the goals of this administration and look forward to catching up soon. Jared Bernstein there from the White House Council of Economic Advisors. Tom, just some of the tension there, just highlighting some of the tension going into talks with the president and the Big Four tomorrow.
The tension's there, and it's one part the fear of growth. What do we do after 6-7% growth? But also, John, I'm going to do, he's got his agenda, he has to talk, but it is about federal versus state rights as a debate.
The big conversation continues. Bill Dudley, formerly of the New York Fed, joining us on the other side. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV, alongside Tom Keene. I'm Jonathan Ferro. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
On Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It is tough for big tech this morning. Romain Bostic is going to run you through the single names in just a moment. Here's the high-level stuff from the top end in the equity market. The S&P 500 down 0.8%. The Nasdaq off by 1.42%. It was ugly yesterday, and we take off some more weight from the Nasdaq 100. Run you through a little bit more with a little more granularity in a moment. Let's get to the bond market. I want to look at the 10-year break-even. So this is the real rate, the nominal rate minus the real rate, and this is what you get. There's just this move, this gap lower in break-evens around the crisis and the shutdown, and then this pretty clear move. Higher, 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 higher. A lot of people use this to gauge inflation expectations, Tom. I think there's one way of doing that, and I think this is an okay way of doing it. But when we talk about distortions in the bond market, we've got to talk about the distortions that we get from a clean read in inflation expectations too. I don't think it's that clean, and I don't think you can do it that precisely in the bond market either, to say this is the piece for inflation, this is the piece for reals. It's a market, and a market that is being shaped in many ways by Fed policy. But what's interesting for me, Kit Jukes at SocGen, others as well, thinking about this, inflation expectations are climbing, real yields are lower, nominals are pretty steady. What does that mean for the FX market? I don't have an answer for it, but this is what it looks like right now. Let's finish on this. Euro dollar. Euro dollar 121.71. 123 was the high of the year. That was early January. If my memory serves me well, it was about January 6th where we saw that 123 handle. We struggled to get back there. So right now, 121.71. And Tom, you've asked the question repeatedly, and I think it's the right one. When does the ECB start to make a bit more noise? Is it 122? Is it 123?
Yeah.
How quickly does that happen?
Yeah, I agree with you. The shading there is something. What we know is it's not 125 to 130. I would know DXY breaking down as we speak, the blended big trading index. It is not through the 90 level, and 89 print would be newsworthy. We don't see that yet.
So that's the FX market. That's the FX market. Tom, before we go, I've got to ask Romain if he thinks this is a hammering. Can we call it hammering, Romain? What do you call it?
Are we cratering?
Come on, Romain. Are we
linguistic
on the Nasdaq?
If we want to call it a hammering, we can call it a hammering.
There we go.
Or a crating, as I think I saw here on the Chiron a little bit earlier. Look, you had 13,160 or so on the Nasdaq futures. We should point out, John, that's actually below the 100-day moving average of the Nasdaq 100, which is right around 13,255. So it's going to be an interesting test at the open. We talk about getting hammered here. You go back to April 16th, which of course was that last all-time high that we hit on the Nasdaq Composite. Since then, 2/3 of that index are in the red, and the stocks that are in the green, none of them could really be considered tech stocks. It's like, you know, Walgreens and Costco and Kraft Heinz. That's what's leading the way. You have a company like Tesla, which of course is down something like 28% from its most recent all-time high, and now it's under pressure here in the pre-market, down about 6.5% because the news out of China saying that its most recent monthly production numbers in China were down about 27%. 3%. On top of that, Reuters has a report out saying that the company may actually put off expanding some of its capacity out there on some land in Shanghai. You take a look at another company like Twitter, which of course was a high flyer. Since that company hit its record high, it's now down about 33% and now down 4% here in the pre-market, back below $50 a share. Remember, this was a big rebound. So that's a hammering. Oh, well, here's a hammering for you. Here's a perfect use of hammering. Take a look at Palantir Technologies. This is a stock down 50% from its all-time high back in January. More importantly, it's been on a 10-day losing streak. Today's going to be 11, down 9% in the pre-market. It reported earnings and the revenue growth decelerating. A lot's going on here, Tom. There are a lot of moving parts here. I know it's hard to keep up with, but this is the hammering you're taking a look at
That's
here.
some great shade, Romain.
Anything with there. And look, it all goes back. Look, you're talking about growth stocks here, and it all goes back to accommodative monetary policy, easy macroeconomic conditions, and right now investors are starting to question that, and you put that up against the fundamentals. This is what you get.
If you survive trading today, you can get hammered with Romain Bostic this afternoon.
Romain, thank you.
On the close. Okay, here's what we're going to do, folks. Farrell's all wound up about Mr. Druckenmiller, so he's going to talk to Bill Dudley about that. I'm going to try to squeeze in 2 questions right now on economics, and Farrell's going to light up the television and radio on Mr. Druckenmiller's essay. William Dudley is a former president of the New York Fed, of course, for years legendary at Goldman Sachs, writing for Bloomberg Opinion. We're thrilled that Bill Dudley could brief us this morning. Bill Dudley, I want to talk about policy rule inertia, the physics envy of guys like you. You do Newtonian mechanics, and up we go. Interest rates start moving up, and we start talking about inertia. What's the inertia look like right now to higher interest rates?
Well, at the short end of the inertia, there's inertia of keeping short-term rates steady. The Fed has said that they're going to be very slow to raise interest rates. They're not going to begin to raise interest rates until they get to full employment, 2% inflation, and they're confident that inflation is going to go above 2%. So we know that's going to take a while to convince them of that. Once they start, however, they're going to be late, and they're going to have to catch up. And so this is going to be a period of slow, and then it's going to be a period of fast. And I think the thing that people don't really fully appreciate is when they actually have to catch up, the level of short-term rates is going to climb much higher than what's currently priced into financial markets.
What you just heard there, folks, is a synthesis of history with economics that Bill Dudley was legendary for with McKelvey at Goldman Sachs. Bill Dudley, I'm going to cut to the chase. In your wonderful essay, you talk about that process of moving from the reality ex post, we're behind, and forward. You talk about talking, and then the Fed will act, and finally they will do higher rates. Will they do it in a measured way, or do we literally go back to Arthur Burns where they're going to be talking about 8th point or higher moves?
I think they're going to have to move relatively quickly because liftoff in terms of short-term rates isn't going to happen until the economy is already at full employment. So there's going to be a big gap between where they are starting and where they need to be to keep the economy from overheating. So it seems to me that at least a quarter point a meeting seems like the most likely template. Think about what happened in 2004 to 2006. The Fed raised a quarter point a meeting for, I think it was 17 meetings in a row, taking the federal funds rate from 1% to 5.25%. Probably not going to go quite that high this time, but we're going to go quite a bit higher, I think, than the 2% that's currently priced into financial markets.
So, Bill, how would you characterize this? Is this a race back to neutral once you do start, or a race through neutral?
Well, you have to go beyond neutral because you're starting because you're already at full employment and inflation's likely to go above your 2% inflation objective. So you actually have to go to tight.
How much of a stable force do you think the market would be in that environment? Just having a look back at late 2018 as a case study to think about.
Well, it's going to be interesting to see how the market reacts. That's the one thing that could slow the Fed down. If the market reacts really poorly, then the Fed will sort of pull back a little bit. But look what happened, though, between 2004 and 2006. The Fed tightened every meeting for over 2 years. And guess what happened? The stock market was fine and the bond market was fine. So you're absolutely right. How the markets react will affect the pace of tightening when the Fed starts.
Are you advocating for a change of policy then, Bill, or just highlighting where you think the risks lie?
I think I'm just highlighting where the risks lie. I mean, there are benefits of what the Fed's doing. It's going to keep inflation expectations better anchored. It's going to get those 8 million people that are still out of work, post-COVID, back to work more quickly. But there are costs on the other side, and people in financial markets just need to be cognizant of some of those downside risks.
What do you think those costs are in the near term? Druckenmiller's out in the Wall Street Journal. Stanley Druckenmiller, famed investor, of course, legendary hedge fund manager, saying the following: the long-term risk from asset bubbles and fiscal dominance dwarf the short-term risk of putting the brakes on a booming economy in 22. What do you make of that aspect of it, Bill?
Well, I think the Fed does recognize that financial markets are frothy, but they're looking through that because they especially for the equity market, they say the equity market, if the equity market were to go down at some future point in time, they don't see it as a big risk to financial stability because investors in the equity market typically don't do so on a highly leveraged basis. If you remember what happened in the great financial crisis, it was leverage that killed us. So the Fed's view is if we tighten and the stock market goes down at some subsequent period of time, that will tighten financial conditions, and we may then not have to tighten monetary policy quite as much. But they agree that markets are frothy, but they're looking through that. They're determined to keep rates low until they actually get a lot more people back to work.
Bill Dudley, I want to digress. We just talked to Jared Bernstein of the White House about this. The arch conservative fear that we're not going to be able to grow our way or that growth won't participate in our debt and our deficit solutions. And this goes back to out at Berkeley where you were, Chip Jones and others, and Solo at MIT, et cetera. The idea that just this fear that the growth won't be there. Frame your optimism that growth, economic growth of this nation will assist in helping us with this pandemic debt and deficit.
Well, I think it will help because we have excess capacity in the labor market. And I think, if you look at the productivity numbers, I mean, it's hard to read them through the pandemic, but they actually seem to be better than what people expected. End of the day, growth is about resources and productivity. Resources, not so much, in the sense that the population growth in the U.S. is pretty modest. So labor force growth is only about 0.5% a year. But productivity growth, that's the key. And if productivity growth ticks up, then you'll have stronger growth.
Bill, just finally, final question. We've got to get your take on that payrolls report from Friday. How would you be processing that if you're on the Fed right now?
I think you'd say, well, that was surprisingly weak. But, we don't have a lot of experience coming out of pandemics. And, it's very possible that it's weak because people don't want to go back to work quite yet because they don't have people to take, they don't have people to take care of their children because schools are still out of session. So I think it's going to just take a while to understand what's really happening post the pandemic. I don't think they're going to put a lot of weight on 1 month's weakness in terms of payrolls.
Bill, a timely piece. William Dudley there, the former Federal Reserve Bank of New York president. Thank you, Bill. Look forward to catching up soon. Tom, just to sum it all up then and think about it, it's going to take a long time to start, but when you start, in the mind of Bill, Mr. Dudley, you're going to see a quicker move towards neutral and through neutral. Because by definition, to put the brakes on, you've got to get through neutral. Obviously, how stabilizing the market is as a force is going to be the big unknown here. Think about what 2018 looked like. 2018, the back end in December, that was rough.
Yeah, well, it was rough. I think it's great to have Bill Dudley on against the Stan Druckenmiller essay here and really stark differences in the balance of traditional monetary policy and solution with this fear of asset bubble dynamics. And so I'm not saying one is right and the other is wrong, but the debate is legitimate and the debate will be framed, John, as Bill Dudley mentions there. Dr. Dudley says it's the events that frame the debate as you go along.
We've got to respect from where those two individuals are writing from, the individual seats. I think to a certain degree, and without putting words in Bill's mouth, I imagine there's a degree of respect for his former colleagues and he doesn't want to advocate for a certain policy in the here and now. It's clear, though, that there are risks, Tom, on the horizon. And it's clear that Stan Druckenmiller in the Wall Street Journal is trying to acknowledge some of those risks, or at least highlight them from his position.
Okay. John, I mean, a research note here from the Board of Governors, Cristina Fuentes-Albero and John Roberts. John, R plus pi plus 1/2 delta pi plus 1 plus y. I mean, those are the equations guys like Bill Dudley are using. Others are just using blunt analysis.
I'll be working my way through that.
Was that good algebra for you? Thank you.
Great. Thank you, Tom.
It was on the edge of John
Crushed.
Taylor.
NASDAQ down 209, down 9 tenths
I thought
of 1%
I was crushed.
on the S&P 500. The producers do that during the commercial break. That's coming shortly. In the FX market, 120.167. Your euro is stronger, up 1/3 of 1%. Crude's lower, 64.21 on WTI. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden says Russia has some responsibility to address that ransomware attack that crippled the giant fuel pipeline. The president stopped short of directly blaming the Kremlin, but he says there's evidence the hackers used all the software they used are in Russia. Meanwhile, some gas stations on the East Coast say they're running out of gasoline. Colonial Pipeline says it expects to substantially restore service by the weekend. The Biden administration is ramping up its response to the global semiconductor shortage. Commerce Secretary Gina Raimondo plans a summit with companies impacted by the shortfall. That includes the largest chip manufacturers and U.S. automakers. According to an invitation obtained by Bloomberg News, the meeting will be held May 20th. And inheritance taxes could make a return to the political agenda after decades of declining use. That's according to a new report from the OECD. Taxes on inherited wealth now account for just 1/2 of 1% of tax revenues in the countries where they are still used. The OECD's research suggests that inheritance taxes could help rebuild public finances that were hurt by the pandemic. Blackstone wants U.S. dealmakers back in the office full-time by June the 7th, as long as they are vaccinated. The world's largest alternative asset manager announced the move to staff yesterday. Financial firms have been preparing for an end to remote work since the earliest months of the COVID-19 pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This issue of cyber attacks on our critical infrastructure, especially energy infrastructure,
is not going away. This is a serious example of what we're seeing across the board in many places, and it tells you that we need to invest in our systems.
That was Jennifer Granholm there, the US Energy Secretary from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz will be back with us on Monday. Here's your equity market this Tuesday morning. Good morning to all. Down 33 with negative 0.8%. The Nasdaq 100 down by more than 1% this morning after a big move lower in yesterday's session. In the 10-year, 160.75. Yields unchanged on the day. The euro firmer, stronger, 121.65 on euro dollar. We advanced there at third of 1%. And we decline. We move lower on crude, 64.20, Tom. We're down about 1% on WTI.
Yeah, two Bloomberg people doing good work today on oil. Javier Blas out on Twitter with a really smart chart. And for those of you with Bloomberg Intelligence, Michael McGlone with a spectacular presentation of some of the hydrocarbon dynamics between liquid fuels and motor vehicle fuels. We get smarter now and we win with Francisco Blanch of Bank of America Securities, head of global commodities and derivatives research. Francisco, it's been way too long. I want you to color now. We have all these legacy issues we're dealing with, our collective memory of commodities, our collective memories of super cycles, and you say, wait a minute, it's a split super cycle upon us. What do you mean by that?
Well, Tom, thank you for having me. I think there's sector of metals and materials which is clearly in a super cyclical upswing, and we're seeing record prices, and we'll continue to see record prices for a lot of the raw materials there. But when it comes to energy, we are not, and in fact, I doubt we're going to see record prices in this cycle. I think we're just seeing cyclical upside swings across the board. Although, as you pointed out, we're down today on oil. But really, the story is that when it comes to materials like timber, we are now at a point where supply is extremely low, inventories are extremely low, and demand's roaring. So prices are extraordinarily volatile. Copper is heading in that direction, with inventories declining quickly and also moving into demand rationing. While as oil primarily is still very well supplied. OPEC is holding back capacity, so we are still trying to figure out what to do with all those spare barrels.
Can you put some numbers on this for us then, Francisco? This split super cycle. Let's deal with the metal side of it. Copper right now is at 10.5 on 11K watch now, seemingly. What are you looking for through the next 6 months, 12 months?
So for copper, we're looking at basically $13,000 per ton, and we think we could go as high as $20,000 per ton if the supply of scrap copper doesn't make it into the market.
Whoa. You just said you're modeling a double off of LME copper?
Our official target is 13,000, okay? But we see a case over the next couple of years, if we do not get enough scrap metal coming into the copper market, because remember, a large chunk of the copper market, about a quarter of it, is scrap, right? So if we cannot scrap enough copper recycle it back into the market, I'm talking about the copper that we get from past uses, not the copper that we are mining, the copper ores. Those are very tight, so we need to keep pushing prices higher also to create more supply, and that's the crazy dynamic that's going on in copper right now. Remember, copper is critical to all the applications that we have lining up for the decarbonization of transportation, the decarbonization of industry, and the decarbonization of the electricity sector. So all of those require a lot of copper.
Francisco, I've got to jump in because we've got to go through these numbers a little bit more. We've got 13K as your base case. We've got 20K as this big bull case. Can you help us understand how big a force recycling of copper actually is in the copper market, and whether you expect that to actually materialize?
Right. So it's about a quarter. I mean, it's hard to tell at this point. Remember, there's a lot of different uses that go into recycling here, and it's possible that it happens. I do think that copper is probably the most constructive commodity out there from a metals perspective, but there are others, right? I mean, remember, we are at the stage where, as I said before, we just printed way too much money. And we never quite had a recession when it comes to goods and when it comes to the demand for stuff and when it comes to demand for industry. We barely had an IP recession last year. So all of this is really booming from a metals perspective, and copper ores are actually degrading quite a bit. So if you look at the supply of ores is declining across Chile and Peru. We have elections as well in Peru coming up, right, where there is potential fears of sector nationalization. And this is also the kind of behavior that you start to get when prices get out of control and governments suddenly see a lot of money in this commodity market, the small commodity markets.
Francisco, our collective memory quickly here is that we had a China boom up to 2008. Do we have a China boom again, or is demand coming from a different theme?
Well, the interesting thing in this cycle is the demand is coming really from everywhere. I mean, for sure, we're seeing strong demand from China. But also, we are seeing a very robust consumer activity in the U.S. You talk often to Michelle Meyer, our head U.S. economist, and she can tell you how strong demand has been here. And part of it is just we've given people a lot of money to play with while they were sitting at home. And also European demands actually picked up quite a bit. And while this is going on, by the way, Tom, I mean, I'm sure you've noticed European carbon prices have reached 50 euros a ton or $60 a ton, which effectively means that there's going to be even more demand for this copper and for some of these metals that are going to help us decarbonize. Because it's so expensive now to burn carbon fuels in the European Union. So there's a lot of things going on simultaneously, really, supporting the complex.
We've got a minute left, and I want to use that by talking to you. Just one more question, Francisco. This big call on copper, is this a cyclical call or a structural secular call? This shift away from the fossil fuels and towards batteries, etc. What is it predominantly?
It's predominantly the latter. It's a secular call. It should play out over a number of years. We think at the end of the day, the initial impulse came from monetary and fiscal. The secondary impulse came from this kind of China taking center stage in terms of growth last year, and now we're getting the U.S. infrastructure and decarbonization impulse. And that's going to take about 10 years plus to complete. So it's a secular story which will continue. It may even slow down decarbonization efforts.
Interesting.
I guess that's a risk, actually, that we end up slowing down decarbonization efforts because we just don't have the materials lined up for it.
Francisco, we've got to run. Please talk to the team. We'll get our team to talk to your team. We'll sort something out so we can do this again. Tom, that's a massive call. Francisco Blanch there of Bank of America. Right now, copper, 10,500 on the LME, looking for 13K as a base case. Tom, 20K?
Well, yeah, the 20, I mean, this is one of those points, folks, through the year where you just stop. Up 30%, okay. Up 80, 90, 100%. No one has that framed.
Coming up, Tobias Levkovich of Citi, the chief U.S. equity strategist, as we get a little bit of pain in the equity market on the NASDAQ. NASDAQ futures suffering. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Everyone's ready, and I think properly should be strapped in for what could be a very wild summer.
The consumer is still seeing spending in excess of what would be considered a normalized pace of spend.
The party on the issuance side has stopped a little bit, but the party on the demand side is still there.
This summer is going to be huge. People are going to spend, and the bounce back in oil demand is probably going to be significantly more than people have been expecting.
Certainly some commodity prices are just completely out of control. It's almost hyperbolic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. It's a simulcast. Great conversation on radio and television. It's a Tuesday after the jobs report, and we have wonderful guests. Bill Dudley just with us. Francisco Blanch will get to in a moment with stunning news. Tobias Lefkovich in a moment. And Jan Hatzius will join us from Goldman Sachs off that David Costin equity note in a moment. John Ferro, the conversation starts here.
Session lows down 1.75% on the NASDAQ 100, off by more than 200 points. The S&P a little bit softer as well. Big tech facing a little bit of trouble, Tom, amidst a conversation about higher inflation and maybe at some point further down the road, higher rates.
Well, I'll say two standard deviations, and we'll get this from Tobias Lefkovich in moments. John, we must go back to what no one is framing worldwide, which is Francisco Blanch framing copper LME up 30%. And if we don't straighten out the scrap issue on copper, a little bit of inside baseball there, we could see a double in copper.
10.5 is where we are right now. 13K is the forecast from Bank of America. 20K is the upside risk over the next couple of years.
No one's framing that.
Beijing isn't. Number. I was in shock too. And yes, Beijing isn't, because China hasn't participated in this super cycle, in the narrative at least, in the conversation on Wall Street in the way that it would have done 10 years ago.
Well, I know you missed my question at the end, John, because you were signing photographs, but you know, the reality is it's important. The last time around it was China boom, very mono, very singular, and Francisco was adamant that's not the case this time around.
I'm always listening, always listening. Higher prices fueling this conversation about inflation. Bill Dudley of Bloomberg Opinion and on the terminal this morning and on .com. 4.5% peak in a Fed's target rate isn't out of the question. Let me tell you, that is not a part of the conversation. Might not be out of the question, but who's talking about that?
Thrilled you're with us for this conversation on radio and television. John, let's do a joint data check here. I'm going to look at red on the screen. Dow futures negative 174, SPX negative 39. The VIX out of stick almost to 21.34 from a 17 level. John, what do you see in the bond market?
I just love you quoting the Dow. It's like offering us the scores on a game no one plays anymore. S&P 500 futures down 37. We're down 0.9%. Big tech is suffering, and that's weighing on the NASDAQ 100. We talked about that being at session lows. That's where it is right now. In your bond market, we're stable. Tom, we are stable. 160.75, pushing 161 on a 10-year.
This conversation is so important. We're going to get to it right now. The acuity, if you will, of what we see within the equity market. We can look at sector analysis. We can also look at the bigger picture in the history with Tobias Lefkovich of Citigroup, their chief U.S. equity strategist. Tobias, are corrections healthy? I mean, down 10%, 9, who's counting? But how do you look at the good of a correction?
Look, you shake out the kind of weak hands of investors who are owning certain stocks that probably they shouldn't be owning. We tend to have these fairly normally. In many respects, the Fed has put a kibosh on them over the last year or so, since they've been providing so much liquidity, and it prevented, I would almost argue, kind of normal course of action in markets.
Tobias, one of my great themes, and this is so important with you, I think of you and Mario Gabelli as former sell-side analysts. You've got a real granular, authentic view. When you look at the distractions, the Fed in this, the Stan Druckenmiller exercise this morning, will C-class officers adapt to that? Do you have a faith that American corporations will adapt to what they're given by the Fed?
Yeah, absolutely. I mean, look, if you have cheaper funding costs, provided by the central banks globally, not just in the U.S., then companies are going to look at what are those credit conditions compared to their return on capital employed, and they'll take advantage of it, and they'll make investments, be that in human, physical, or working capital. So they are very adaptable. They are flexible. I mean, think about, even from this perspective, Tom, just how remarkable the response has been from corporate America over the past year in face of the COVID threats, not just to their employees' health, but also to the business's health. And they have been able to adapt pretty remarkably.
Tobias, you still at 3,800 year end?
Actually, we bumped it, Tom, to 4,000 on Friday.
Okay.
Basically driven by the very powerful earnings we've seen. We saw more than $7 of better than expected results in the first quarter. So we took our earnings estimates up as well from $173 to $184. And given that move, we were forced to move up the target, but we still think there's downside risk here.
Is there a compositional shift in the forecast as well, Tobias, the parts of the market you do and don't like?
Mm-hmm. Yeah, absolutely. So we're more in the value perspective over the growth perspective. And, I think I may have mentioned this on your show in the past. We almost think of the market as a bit of a dog sled, and it's been pulled by the mega cap tech huskies, if you like. And as they lose some of their pulling power, and we replace them, if you like, with, instead of huskies, cocker spaniels, poodles, and chihuahuas in the form of animals, they just don't have the same pulling power.
A little bit of a connection issue there with you, Tobias. I'm just going to jump in quickly. Tobias Lefkovich of Citi with us. We'll try and re-establish that. I think we've done that already, Tobias. Let me just jump in with what Amazon issued dead at yesterday. 10 basis points over the US 2-year. $1 billion worth of debt at the front end, 18.5 billion overall. Tobias, I'm trying to understand how hard it is to be bearish some of these massive names, given the cost of funding, given the levels of growth, given the amount of earnings they churn out every single quarter. How difficult is it to be bearish those names?
Well, it's hard to be really bearish. And if you even see what's going on in the market, they're taking it out in kind of some of the software names, some of the what you would call beneficiaries of shelter in place, work from home, kind of COVID aspects. Those are the stocks that are really getting hit. It's not as much in the the name you mentioned or some others. They've just stalled, right? The really big mega cap stocks have stalled. And if you look at them over 6 months, they really haven't done much. And as a result, we could see some weakness. We had one of our analysts downgrade a couple of the big ones yesterday, talking about the advertising activity about as good as it can get, and therefore it could slip a bit. So again, this is not 1999, 2000 all over again with a bubble that leads to 35% pullbacks in markets, but 10% are pretty normal, and I think people have forgotten that.
Tobias Lefkovich, Liz Ann Saunders at Charles Schwab features on Twitter moments ago the NFIB job opening survey. Truly, John, it's not a hammered, it's not a crushed, it's not a cratered. It's a true record spike of job openings. Can you fold that over to reduced margins on the income statement?
Sure. One of the things we get a lot of questions about, Tom, is this issue around what could stop this market's ascent? What are the catalysts for change? And we talk a lot about taxation, the Fed, inflation issues. But one of the other ones we're talking about is margins. If you look at the NFIB data, the percentage of small business looking to raise prices less the percentage of small business looking to raise compensation. And remember, you don't raise compensation willingly. You do it primarily because the market demands it. So that gap is actually shrinking. In other words, we're seeing fewer companies able to raise prices relative to that compensation issue. And if you have all the jobs available and you need to fill them, you're going to have to pay up. And remember, 60% of corporate cost in this country is labor derived. As a result, it's not as much what happens in oil prices or copper prices, but it's very, very important what happens in labor costs. And it looks like we're going to run into some trouble in the next 6 months. Differential between price increases and cost increases, and that could hurt margins and disappoint a very bulled-up investment community.
Tobias, let's go all Jack Welch to the late, great Jack Welch, and he talked about pricing power. Okay, you get wage issues as well. Do you observe sectors, certain sectors, that truly have pricing power?
So there are certain areas in the market that do have it. Cybersecurity, very few of us are going to want to risk not having protection. I think a lot of us who are using streaming video are getting some attraction price. It's also certain staples. I've always joked that one of the most inelastic pricing areas would be things like disposable diapers. People pay whatever the price is to not go back to using cloth diapers. So there are products, cigarettes, even railroads with tight capacity, lab equipment, where you have some dominant market positions. So there are different areas that do have it. And some of the things you have to be worried about is the areas where you might have more labor intensity that you won't be able to capture it.
The view from Citigroup. Tobias Lefkovich there. Tobias, thank you, sir. As always, the chief US equity strategist. Tom, on your point on these small business job openings in America right now, here's the Morgan Stanley take. Disappointing employment report, the one from Friday, suggests labor availability may be a gating factor on the speed of reopening. While these problems haven't broadly affected margins yet, stocks are discounting mechanisms and don't always wait for an engraved invitation. That's where a lot of people are laser focused, and for good reason, Tom.
I totally agree with that, but then I would fold it over, John, to a recalibration of what GDP does, and I really haven't seen that yet. My guess is the market houses are waiting for the inflation data tomorrow and the retail sales on Friday before they rejigger their GDP numbers through the year.
And for the next jobs report as well. Yeah. The PMI, the ISM, come on, every single data point has just said demand's not a problem. Every single data point has pretty much said that.
Copper says that. Francisco Blanche says that with copper.
The price action does too. It's a supply-side story for so many people. For so many people, that's the overwhelming consensus view.
John,
it's what's driving the shortage in the labour market. That's where there's a big political debate at the moment.
John, radio can't see this, but I tear up when I see that our control room in America brings up London copper to keep you happy.
Isn't that nice?
It's just,
is that just for me, or is that just the way to do it?
For those of you on radio, it's just,
When we got the forecast from Bank of America, what did he give you that forecast in?
He didn't know me.
Francisco Blanche do?
No, I get that.
There we go.
Okay.
When we get the forecast year end from Citigroup, what did they give you that forecast in? What did he say? What did he say?
John, you're getting testy here.
Did he give you a Dow forecast?
I don't know.
Give you an S&P 500.
Good morning in Chicago. Good morning,
Chicago. Against Chicago. Love Chicago.
Oh, sure, I could see.
Yeah, big fan of Chicago. Nothing wrong with the CME. No problems with that. Just that's what we quote. That's what we forecast. Coming up, Sarah Hunt, Alpine Woods portfolio manager. Well behaved on this show. From New York City this morning, good morning. Alongside Tom Keene.
Dow futures negative 184.
Farrow. Thank you. Some value add, TK. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. More fallout from the shutdown of North America's largest petroleum pipeline. Gas stations along the East Coast are starting to run out of fuel. Colonial Pipeline says it expects to substantially restore service by the weekend. That may not come fast enough to avert immediate shortages in the southeastern U.S. That shutdown over Jerusalem has turned into one of the most intense confrontations in years between Israel and the Palestinians. Militants in the Hamas-ruled Gaza Strip fired rockets into southern Israel overnight, and Israeli aircraft responded by pounding their facilities. Israel also ordered troop reinforcements, and reserve forces have now been called up. A blockchain platform backed by billionaire Peter Thiel is launching a crypto exchange. The exchange will be called Bullish. It's being capitalized by Block.one with about $10 billion in digital assets and cash. Bullish seeks to combine the attributes of traditional exchanges with the benefits of decentralized finance. And Ginkgo Bioworks has agreed to go public in a $17.5 billion reverse merger. The company will merge with a blank check firm backed by investor Harry Sloan. The transaction includes a $775 million private placement that includes Bill Gates' Cascade investment. Ginkgo uses technology to program cells for potentially a wide variety of uses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
For copper, we're looking at basically $13,000 per ton, and we think we could go as high as $20,000 per ton if the supply of scrap metal, scrap copper, doesn't make it into the market.
The kind of numbers that make you stop and listen. 13K, 20K, Francisco Blanche there, Bank of America, from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Bramwitz back with us on Monday. Here's the price action this Tuesday morning. Equity futures down 47 and off by more than 1%. We are looking at session lows on the NASDAQ 100 as well. In the bond market, 160.93. We're advancing there by almost a basis point. No big moves in the bond market, though. Yields are pretty much unchanged. In the commodity market, 64.11 on WTI, down by more than 1%. And euro dollar, Tom, just quickly, 121.67, advancing of 1/3 of a 1%.
Thank you so much. What we're going to do now is digress. We talk to a lot of people in strategy and economics and, of course, in politics. It is rare we talk to someone in true wealth management, managing money and doing so in a time where portfolio construction is how much Apple do you own, how much Amazon you own. Sarah Hunt is scarred from years of dealing with clients at Alpine Woods Capital over portfolio construction. Sarah, what are you doing right now? I mean, if you didn't own enough Apple and Amazon and the rest of them last year, how are you recalibrating in your portfolio right now?
Well, it's an interesting question because obviously you've seen a big move in some of these tech stocks and not a positive one in recent days. I think we were already at the beginning of the year in January and February thinking that things looked a little bit stretched, and we're starting to look for value, but value in unusual ways. So, one of the stocks that we looked at is a company called Akamai, and they were one of the early people using the internet and figuring out how to fix bottlenecks. Well, they've gotten into security, and as you mentioned earlier, security is a big market right now, and people are very concerned about. The pipeline issue just exacerbates that. So they had a big part of the business that was not growing and a small part that's been growing very rapidly. That's the kind of place where we're looking for a sweet spot where we look, it looked like there was some opportunity.
Is it right now?
It's a combination of both, really, because you've seen some very big movements under the indexes, where you've seen some big rotation into value and into sectors like the cyclical sector and out of some of the technology sectors. Healthcare has been a little bit of both. You've seen some things that are very positive and some things that are not. Biotech has had a very
So
hard
what do you do with healthcare?
Well, I think that you continue to invest in it. I mean, this is clearly a space where you're going to see growth, and you're going to see continued growth as the population ages, not just in the U.S., but globally. But you also have to figure out how much was the pandemic a problem, and how much are we going back to some sort of normal in our own healthcare system and other healthcare systems, because the healthcare system has been skewed by this global pandemic. And you see that in the numbers. So you have to assume that at some point the numbers start to change, and some of the more traditional operations like hip replacements and knee replacements and all that start to come back a little bit stronger. But right now you're still in a little bit of limbo because you don't have what I would call some sort of normalized procedurals.
Let's get to the numbers right now. NASDAQ 100 down by 1.9%, just off session lows and off by 250 points. Is this price action in search of a story, Sarah, or do you like this explanation, the narrative that's gripped the market this morning, that a lot of this is just the reflationary thing bleeding into big tech growth and it's not good for it?
Well, that's an interesting question, because earlier you mentioned that Microsoft isn't really an inflation hedge, and traditionally speaking, it's not. But do we really think that Microsoft is going to have trouble raising its prices? Like, the issue about pricing is something where on the technology side, a lot of those people do have pricing power. So the question is that really the issue, or is this really rotation out of some names that had moved very quickly and very fast? Take a look at Nucor. That stock was a bottle rocket the other day, and it's gone from 50 to 100 in a very short period of time. I think that's part of the supply chain shortages you're seeing as people start to look at that, but then they tend to extrapolate pricing for periods of time that may be too long. So there is some movement into the cyclicals, but is that movement going a little too far too fast is another question, just like it was in tech a little too far too
Let's
fast.
build on that then, Sarah. The relationship you think should exist between yields, rates, real yields, and a broader market, growth equity specifically.
I think it's a very difficult thing to say that we are going to see much, much higher interest rates, even if the Fed does have to raise. If you think about global governments, everybody's borrowed so much money that I find it difficult to believe that rates can go back to what we used to think of in traditional, sort of 5-6% on a 10-year. I think that's very difficult because it's very expensive for governments now if rates are that high.
I want to dovetail two of these arguments, John. I think this is absolutely a brilliant conversation about portfolio construction. And Sarah Hunt, what it comes down to, as David Constant and Goldman mentioned, the duration framing of these big tech stocks versus a Jack Welch much like pricing power, and you're saying the market's wrong. These people do have pricing power. To me, John, that's the huge debate of the end of the summer.
So BTIG, like consumer staples. Morgan Stanley, I think, likes consumer staples. Sarah, I keep hearing firms, banks, houses that like consumer staples because they like the pricing power aspect of it. Do you?
I think that given where the multiples are on consumer staples, I'm not sure that they have as much pricing power as you have in some other areas. So I see the argument, but I also think that in the end, you've got a lot of choices. Consumers do make choices. They will trade down in consumer staples in a way when budgets are tight that they won't. You can't trade down from Microsoft to a different security system or a different brand. I mean, I don't see that kind of trade-off happening in some of the areas that are traditionally linked to lower interest rates are better for them.
This is like, John, such a flashback when Toto's Africa peaked in 1980 at number 19 on the Billboard chart. I mean, I'm going to get misty-eyed here.
That was beautiful. Sarah Hunt, thank you. Alpine Woods
Sarah,
portfolio
that was
manager.
great.
Whenever you bring up Toto, do you know how many times I've shared the story of you and Toto? When did you decide that Toto was the anthem for this program?
I don't know when.
What was behind that?
It's the only, Ken Fellio, our global technical director, it's the only song he could figure out. He was so tired from the Fellio.
True story. I share this often, that one day Tom and I were at it was a barbecue for the building we both lived in, right?
Yeah.
How many years ago was that? Long time ago.
Weeks ago.
Wish it was longer. Anyway, we had a barbecue and you walked out and there was a DJ playing music and you got him to play Toto Africa as you walked out into the yard. I still don't get it.
Well, you know, it worked then, it works now. John, that conversation we just had, we don't do enough of this, folks, because it's early in the morning and we're doing Copper and Francisco Blanche and Bill Dudley. But Sarah's in the trenches of what do you do? And John, her message to me was she's not worried.
Yeah, commodities higher. Break-evens have been breaking out. I get all of that. But yesterday, that move, that big drawdown that we saw in the big names, the big tech, the NASDAQ 100 this morning, and we're looking for price action first, narrative second. We're always doing that. Most people are always doing that.
Well, the tape's deteriorating right now.
It's an inflation story this morning, though. Do you see that in yields?
I don't know. I see Dow futures negative 277.
Yeah, and I see NASDAQ futures down hard too, off by 1.95%. But is that driven by these inflationary concerns or something else? Is it just a correction?
You never know.
As you've been saying all morning, is it just a correction?
Well, first of all, we're nowhere near a correction on a standard deviation basis, sort of, kind of like. But to take your point, there's worries about there, and that set of worries is what you've got to glean out. I thought Sarah was great.
Jan Hatzius joining us next. That's another great guest. What a couple of hours we've had on Bloomberg Surveillance.
Our team is just
Goldman, chief economist, next on Bloomberg Radio and TV.
Matt,
this
Natalie,
is Bloomberg.
All of them. Oh.
traffic.
Okay.
During the pandemic, no traffic at all.
Okay. Where do you see the oil market in about 20 years or so?
Non-existent.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live on TV and radio for our audience worldwide, this is Bloomberg Surveillance. Things are getting a little bit choppy out there. Here's the story right now. NASDAQ futures off by 263, down by almost 2 percentage points. Pain yesterday would take more weight off that rally of the last 12 months. The S&P 500 down about 55 and off by 1.3%. A lot of this driven by the big tech names, the mega caps. If we switch up the board and get to the bond market, if you saw that picture of equities, what would you expect bonds to look like? To expect to see something, wouldn't you? Your 10-year yield is basically unmoved, up about a basis point on a 10-year to 161.28 on 30s to 233.88. We inch higher there by a single basis point. And this conversation about pricing power is dominating the conversation right now with equity investors. And Tom, we mentioned consumer staples just moments ago. Switch up the board and finish on this. The staples year to date are up about 4.9 to 2%. But it's the move off March that gets your attention. The move off March where we started to rip out about 10 percentage points and change, by more than 10% that rally, Tom. Morgan Stanley, BTIG, they expect to see more of the same. They like what they see in staples.
To this day, I can't figure out staples versus discretionary as well. We welcome all of you on radio and television, John Farrow and Tom Keene, and right now a special guest with us. With markets deteriorating, we'll do more data checks here as well. We've got SPX at negative 56, Dow negative 312, and the VIX 22.60. There are hallmarks through this pandemic that you remember, and one of us was in the depths when it was really ugly out there with Jan Hatzius of Goldman Sachs as he appeared tireless from the Goldman Sachs offices. Really, I think the first economist to get back, and in honor of Dr. Hatzius, I go tireless for this good conversation. Jan, I want to talk about where we go from the jobs report, from inflation tomorrow, where we go from retail sales on Friday. How do you assume you will readjust, or in the way that you will recalibrate your GDP forecast?
Well, we have recalibrated to some degree the pattern of job growth. Friday was, far below expectations, obviously, and I think there is a good argument that it's just hard to see these really high seasonally adjusted numbers in the months of the year when the seasonals are looking for big increases. There's a lot of seasonal hiring at this time of the year. I think it's quite plausible that employers maybe prioritize post-pandemic hiring over seasonal hiring to some degree that then shows up as weaker numbers. That's still going to be with us, I think, for the next couple of months. But the flip side should be stronger jobs growth numbers than we previously thought later in the year. So on payrolls, I think some adjustment was warranted. On GDP, we haven't made any changes. We still think Q2 is going to be probably the peak growth rate we're a little over 10.5%. So it's a very rapid pace of growth in Q2, but then I think it does probably slow down somewhat after that.
How do we adapt to a Jeff Curry commodity boom? Dr. Curry has been way out front on talking about the inertial force of metal prices and others as well. How do you adjust your GDP oomph, if you will, to what Curry talks about?
Well, I think it's not clear that it has a major impact on GDP. I mean, I think there are positives and negatives from changes in commodity demand supplies. In some areas it's positive, in other areas it's negative. Clearly, it is a reason to expect much higher inflation numbers in the short term, and that's particularly true for headline, but it's true to some degree for core as well. And I think over the next couple of months, we will see significantly stronger inflation, 2.5% for core PCE, maybe 2.7% in May for core CPI. And I do think that that is probably one of the reasons why the markets are having a difficult time at the moment. We've had some weaker numbers on payrolls. At the same time, the highest inflation numbers are just ahead of us. I do think, though, that ultimately it's going to be more temporary. A lot of the drivers of inflation, not just the commodity numbers, but also things like the base effects and some of the impact of reopening on service prices, a lot of that is pretty short term. Doesn't really tell you a lot about inflation in 2022, when we think we'll probably be back to about 2% for core PCE.
Yeah, and just in the meantime, this was the take from Mike Wilson over at Morgan Stanley, who said disappointing employment report from Friday suggests labour availability may be a gating factor on the speed of reopening. What's your reaction to that?
I think there's probably something to that. I mean, I do think that there are some signs that labor supply is more constrained, not only the weaker jobs number, but also pretty high wage numbers, especially in Friday's report, high vacancies, relatively high quit rates. And so I do think that, for example, the $300 per week extra top-up unemployment benefit probably is an issue in some areas, especially low-paid industries. However, it is fairly temporary because it's scheduled to expire in September. If this was still going to be on the books for, a year or two, then I think it'd be a much bigger concern, but it will diminish, as will other reasons for, more constrained labor supply, namely fear of the pandemic and the fact that schools in many places are still not open. So all of these things, I think, are going to get better a few months down the road.
So clearly, Jan, you don't think that the supply side issues in the labour market need to be addressed with higher prices, higher wages?
Well, I think they might have some of that impact in the short term. My point is just that, especially if I look at this as a policymaker, I'm going to care more about the medium term. What does this tell us, for example, about inflation in 2022, 23, et cetera? And I think the significance is really more limited.
Jan, there seems to be a mystery on pricing powers. Revenue on the corporate statement is unit dynamics and price dynamics. I know it's a study from ages ago. Maybe you're going to do a Friday note on it. But are we going to see pricing power from corporations?
Well, I think to some degree, we are seeing it in the PCE and CPI numbers. There are some increases. I mean, clearly in the service sector, if you're an airline, you had no pricing power a few months ago. You clearly have more pricing power now, and I think that's not yet really shown up in the numbers, only to a small degree. So we'll see more of that. But so I do think increases in prices in a number of areas are going to correspond to more pricing power. The question is just, is it a short-term issue or a long-term issue? And again, I think it's more short-term.
I look, Jan, at the path from Bill Dudley to Jan Hatzius, and of course, the former chief economist for your shop, writing a wonderful essay for us. And he really talks about the inertial force once rates get going. I don't want you to compete with Bill Dudley, but I'm curious what you think about the momentum of rates moving higher once they finally move.
Well, as often, and of course, Bill has been a great mentor, as often, I basically agree with the idea that this is going to be a later, but probably somewhat steeper tightening cycle. We don't have any hikes in our forecast until early 2024, despite an optimistic view on growth. But we do think that, once they get going, maybe it's going to be slow at first, but ultimately we'll see probably more rate hikes than what's currently priced. In his article, Bill points out correctly that the market currently is priced for a terminal funds rate of about 2%. And I do agree that that the actual level is likely to be quite a bit higher. The Fed's saying 2.5% for the longer term funds rate. And if they wait for a long time, because they really want to be sure that the labor market's at full employment and inflation is going to be above 2%, then probably they're going to have to go above 2.5% in the end.
What's quite a bit, Jan? Quite a bit higher. Bill Dudley says 4.5% as a peak. Not out of the question. What's quite a bit higher for you?
Well, so I would say more than what markets are pricing. I think 3% would be a little bit above the, 50 basis points above the Fed's current estimate of the longer term funds rate. Could it be in the, low to mid threes? I think that's possible. I mean, it's hard to, have a strong view on something that is a number of years away, but I do think it will be above what markets.
I'm just wondering, Jan, how we tolerate that in an economy we've just added a ton of debt to. How would we tolerate a rate of Fed funds of 3, maybe 4, according to Bill?
I think it depends on what else is going on in the economy, and if there is a strong bid, for example, from governments still running larger deficits than in the pre-pandemic period, I think that would mean that the government is basically demanding more savings. The private sector then has to supply that savings, and that may require somewhat higher rates than what you had in the previous cycle. I again want to emphasize that a lot of these things are pretty far away. I mean, in the near term, I actually have a more dovish view on where funds rate is going to go than what markets are pricing. I think the Fed's going to get started later than what's currently in the market. But I think a lot of things can change on a horizon of 3, 4, 5 years.
Interesting. Jan, we've got to leave it there.
Jan, thank you so
Jan
much.
Hatzius of Goldman Sachs, the chief economist and head of global economics and markets research. How did the no-tie thing start, Tom?
Hatzius, it's all Hatzius' fault.
We've got to bring it back.
No, it was Hatzius' fault.
We've got to go around Manhattan all summer, just,
I'm going to say, like, when Jan showed up to do this, in the spirit of things, like 3,500 people died. And we were looking for any light moment, and there it was with Hatzius showing up cool, calm, collected.
Well, here's a light moment. Do you think that when the face-to-face client meetings restart, begin again, that these come back?
I don't. What do you think, John? What do you think about? I mean, and that and other traditions, as well.
I wonder what happens with a handshake. Whether it's going to be the elbow bump for life.
You think
the handshake comes back?
I'm like handshaking still.
Are you?
Yeah, I am. I'm an idiot.
I'm going to go with the elbow.
I don't.
I'm going to go with the elbow.
Can you see me doing this?
I wear the tie. I don't see you doing that because you're too high up, Tom.
Well, we're going to, we have a poll going worldwide. We're bringing in,
I'll ask the question out on Twitter. It's as if nothing's happening in the market. It is. We're down 1.22% on the S&P.
A little bit better in the last 10 minutes.
A session lows was down a little more than 2%.
Oh, you're so gloomy.
160.93 on 10s.
The tape
This was fun,
deteriorates.
Tom. We'll do it all over again tomorrow. Isn't that exciting?
Oh, God.
Looking forward to that. You and me together. Will they let us in the same room?
Who's got Dwyer? You have
Dwyer? I've got Tony.
How come I don't have Dwyer?
Tony's joining us a little bit later. Tony Dwyer, a Canaccord Genuity
one of your
on
properties.
Bloomberg Television. Alongside Tom Keene, I'm Jonathan Ferro. NASDAQ futures down 2%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden says Russia has some responsibility to address that ransomware attack that crippled a giant fuel pipeline. The president stopped short of directly blaming the Kremlin, but he says there's evidence the hackers, all the software they used, are in Russia. Meanwhile, some gas stations on the East Coast say they're running out of gasoline. Colonial Pipeline says it expects to substantially restore service by the weekend. The Biden administration is ramping up its response to the global semiconductor shortage. Commerce Secretary Gina Raimondo plans a summit with companies impacted by that shortfall. That includes the largest chip manufacturers and U.S. car makers. According to an invitation obtained by Bloomberg News, the meeting will be held May 20th. And Palantir Technologies posted a bigger-than-expected loss in the first quarter. The company blames stock-based compensation that more than tripled in the period that ended in March. It was created to provide tools and consulting to the U.S. and allied governments. It's overhauled its software in recent years to attract more businesses and to lower prices. And Dogecoin rose today after Elon Musk tweeted about whether Tesla should accept it for payments. Musk's tweet has 750,000 respondents within a half hour. The fourth largest cryptocurrency has proved famously volatile. Over the weekend, Musk appeared on NBC's Saturday Night Live and jokingly called Dogecoin a hustle. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Ritika Gupta. This is Bloomberg.
Tuesday, Bloomberg Technology brings you a special look into the recovery and renewal happening in Boston. Hear conversations from business and political leaders, including Moderna co-founder Noubar Afeyan, Bain Capital co-chairman Steve Paliuca, and Boston interim mayor Kim Janey. Catch the Bloomberg Technology Special on Boston's recovery, Tuesday at 5:30 p.m. on Bloomberg Television.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's not transitory. We're going to continue to have what I call inflation, and that is devaluation of currencies. And I think, of course, with the way governments around the world have been printing and releasing new currencies into the market, particularly the U.S., you will have the inflation numbers going up, which basically is a reflection of the currency.
Mark Mobius, Mobius Capital Partners, truly one of my favorite people out there. Many would say he invented EM equity investing. It's always good to catch up with a gentleman with a huge global perspective. And particularly talking of Mark Mobius or his mentor, Sir John Templeton, is important to talk to Barry Ritholtz of Bloomberg Opinion about David Swensen. Let me do a data check right now before we get to Barry here. Futures negative 51, Dow Futures negative 276, almost three big figures on the VIX, 22.18 on the VIX right now. So that's a meaningful move back. We'll watch this through the morning on Bloomberg Radio and Bloomberg Television. Barry Ritholtz, one thing we know is David Swensen was never looking at the data check. He had a magnificent long-term perspective. He was one of the great mentors to you, to me, and to everyone about a measured approach in active investing. What was your number one lesson from the gentleman from Yale?
Well, you have to look where the crowd isn't yet. What we call the Yale model was essentially Swensen being one of the very first people to push into things like alternatives, private equity, venture capital, things like that, as well as things like timber and farmland. He was first in a lot of spaces, and that's where you find value. When you're the last person into the trade, all of the inefficiencies of the market by that time are long gone.
Buy the rumors, sell the news. And of course, in the heart of the pandemic, tech was, cratered like everybody else. And of course, tech boomed, and we've got the news of a better pandemic and a better future ahead. Where is your value right now, like tech was 12 months ago?
Look, tech is never cheap. Growth is rarely cheap. For about 5 minutes in March 2009, things were reasonably priced. You had something very different than what you saw in, let's call it October 2002, after the NASDAQ dropped 80%. We haven't seen tech that cheap in a long time. And there's a reason for it. It's transforming the entire society. We don't talk about telephone companies or electricity companies that use that, because every company uses that. Well, that's what's happening with technology, and it's having a big impact across the board. At a certain point, it gets ahead of itself. If this had a number of other factors, I would think we could call it the Elon Musk top. But this just looks like tech got ahead of itself and is retracing back to its long-term trend line. That's very different than what we tend to see at a market top.
Futures negative 52 now, 41.32 on the SPX level. Barry, back to David Swensen and the battle over passive and active. You've been truly one of the world's leaders on this constructive debate. So much of it to me is the kind of diversification you do. David Swensen was so good at larger asset sector diversification. Right now, does sector beta or individual beta matter? Are you worried about individual security selection or getting the right sector?
So I don't really care about sector beta or sector alpha, because nobody has demonstrated an ability to time that on a reliable basis. And, you can argue, some people go back and forth between growth and value. It's really tough to get that right. And even when some managers do manage to get it right, you can't tell, hey, do they have a model that works, or did they just get lucky? So we try not to get too involved in that. We want to be somewhere between 60 and 80% passive, and then 20% in things that we hope will outperform, whether that is a style bet like small cap or value, or a specific concentrated bet. We have lots of clients who have built their wealth from concentrated positions in their employer's stock. So if you work for BP Amoco for 25 years, or Google or Apple or Amazon or Microsoft, or name the company, and you've been diligently holding on to that stock, you're dealing with an outsized pile of performance. Being able to select that in advance when you're not an employee of the company, exceedingly challenging. And I could show you For every Amazon, there's 100 Lehman Brothers and Qualcomms and all the other hot names that eventually rolled over and died.
You know, Barry, it's so interesting with the print of Dow 35,000, where we understand it's a great bull market. Within your history, and particularly because Ritholtz, folks, enjoys making and losing money for people, there's nothing like real world experience. How do bull markets end?
You know, there's this rumor that bull markets die of old age, and that couldn't be more wrong. Bull markets don't die. They're killed. They're murdered by policy mistakes. Either the Fed over tightens.
Do you see it right now with Stan Druckenmiller's essay this morning? Are we there right now? I
haven't got a chance to read it, but I heard you talking about it earlier. And I think he's, you know, the gist of it is correct. The Druckenmiller, from what I heard, says the Fed is right to let inflation get a little out of hands. The inflationistas who have, let me point out, have been wrong every cycle since the 70s. They're the ones who are at risk of killing the bull market. The faux chicken hawk, deficit chicken hawks, the inflationistas, the people who want to take the punch bowl away early, that's what'll kill a bull market. A little bit of inflation, even if we're at 4.5% for a couple of quarters, some transitory inflation, some spot shortages, that's not the sort of thing that we saw in the 70s. And that's certainly not Zimbabwe or South America, or they've got it wrong. P.S. I never used to believe this, but I've come around to thinking that the political class now have engaged in this sort of let's do what we can to kill the recession, to kill the expansion, to hurt our opponents. You see that in the fake deficit commentary. You see that in the inflation commentary. You see that in the criticisms of the Fed.
It's become politicized.
These are people who are motivated not by what's best for the economy, but by hurting their political opponents, and they need to be called out for what they're doing.
Another theme, Barry Ritholtz, we look for that from Bloomberg Opinion as well. Thank you for joining us. There's some important comments from David Swenson in the perspective of Mr. Ritholtz. Right now, I've got negative 52 SPX, Dow futures negative 278, NASDAQ futures 2.02% down, and the VIX 22.24. Not out three big figures, but 2.6 big figures on the VIX gets my attention as well. The currency space, I'm waiting for 89 on DXY. I don't have it yet in the developed economy. Watching sterling, hoping Farrell will go home. 141.52. Farrell needs a 144 pound sterling to exit across the Atlantic. Tonight, Bloomberg Technology from Boston, exploring the state of their biotech, their education, as the city opens to the success of a 6-11 Boston Red Sox. Stay with us on radio. On TV, this is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
There's a little bit of pain in equity land. From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now. The S&P 500 down by 1.3%. The NASDAQ 100 off by 2 percentage points. We begin with the big issue. Inflation fears gripping markets.
Inflation is here.
The tech sector being a key example.
The equity risk premium for the NASDAQ.
As yields do move higher and as these inflation expectations rise,
margins are going to be under pressure.
The tech sector will start to be weighed on more heavily.
There is more vulnerability in that space relative, I would say, to the bond market.
Where does fragility in the equity market come from?
The 10-year yields have hardly budged.
We've been all sort of watching this breathless rally.
And we're seeing some of that froth come out.
The textbook is not playing out.
Everybody now is all excited about inflation.
The or inflation narrative has some legs.
The near-term dynamic is much less clear.
It could be quite an inflection point in markets.
Joining us now is PGIM's Robert Tipp and George Bory of Wells Fargo Asset Management. Gents, it's great to catch up. In this market this morning, it's dominated by a downdraft in big tech. In the equity market, the NASDAQ 100 off by 2%. Pick a name, any name. Amazon, Apple, Microsoft is struggling. And Rob, the thing I keep hearing repeatedly through the morning is inflation fears. And that's why these names are down, and that's why these names are down so hard. Yet, Rob, when I look at the bond market, do you see much of that?
Yeah, you see a bit of that. We have, of course, a lot of supply coming this week, but we're seeing some pressure on the market, a little bit of bear steepening, as I think people are, wrapping their minds around the combination of a little bit slower job growth last week. So that suggests the Fed will be more tolerant of inflation and more interested in encouraging growth and keeping short rates lower for longer, which then, creates a higher risk of inflation in the long run. So you're getting a little bit of bear steepening here, no doubt.
George Bory, your take.
Yeah, hi, good morning, John. Inflation's a funny thing. Inflation is a feeling. It's an expectation. It's very difficult to model, and different people, different folks in the economy have different views on sort of how inflation works. Right now, as you pointed out earlier, expectations, at least in the financial market, are high. Inflation expectations have been moving higher. Inflation is actually moving higher, but bond yields are still stubbornly low. And we think you're going to see this period with high inflation or higher inflation and low yields likely to persist. As we just mentioned, the curve is catching up, but it's catching up slowly. And with the Fed pretty firmly anchored at the front end, it's going to be hard for the bond market to sort of overshoot. So we see kind of this dichotomy persisting with higher inflation and lower yields as sort of a go forward type of situation, over the next perhaps a couple months.
So, George, put some numbers on that. So if you take the break-even, which, as you guys know, I don't have to explain this to you, it's just the nominal minus the real yield. And if you're looking at higher inflation expectations and stable nominal yields, I'd expect you're looking for a much, much deeper negative real yield. George, what kind of number are you looking for? Because right now, we're south of negative 90 basis points.
Yeah, no, I mean, real yields could get, can continue to go negative. And I think it's kind of our base expectations as we go into this year. There's this big question about, is inflation going to be transitory or is it going to be sort of more permanent, if you will? The conventional expectations right now are that inflation is going to be transitory, that we're going to see a kind of a flood of cheaper goods come into the system as sort of growth pressures sort of moderate at the end of this year. That's a very big assumption. You see it in financial markets, you read about it in the press. We're not convinced that that's going to happen quite as orderly or as smoothly as that, which means, real yields couldn't get meaningfully more negative from here.
Robert Tibb, do you agree with that?
I think there's going to be a grind, slightly more negative in real yields. But I think, in the next month or two, we'll probably get a cresting, a topping out of these inflation fears. I mean, we're at peak helicopter fiscal stimulus right now and peak unlocking and optimism. And so you're going to have these pressures where not enough goods have been created, not enough people are necessarily there to deliver services, and the demand is surging. But once you get to the precipice a few months forward, and that may sound crazy that you would see a dampening, but think about it. We just saw a 20% increase in personal income in 1 month. The annualized rate of personal income is higher than the entire GDP for the prior year, right? So this is a surge in income. We saw, has that flowed through to activity? We saw 10% increase in retail sales in 1 month, and maybe that level will be supported for another month. But then as the economy is naturally accelerating, there is going to be a deceleration of the fiscal that's very aggressive. So I think looking a couple months ahead, you're going to see some of these fears of runaway growth, runaway inflation, begin to moderate. And frankly, I think you've already seen some of that in terms of change and trend of nominal bond yields in the last few months.
Yields 161 on 10s this morning. The Nasdaq 100 off by more than 2%. With a price action, here's Katie Lyons. Hey, Kaylee.
Hey, John. Well, it is a tough day if you are long technology, and that is true all across the world. What really started yesterday with the worst day for the Nasdaq 100 since all the way back in March has bled through equity markets globally, and that really was just amplified, that fuel to the fire added by the inflation data out of China. Producer price inflation higher than expected, 6.8% year on year. So as a result, on the back of that data, we did see Asia Pacific technology stocks down 3.4%, the worst day since all the way back in late February. And the Taiwanese equity benchmark, which is 57% tech, was off by the better part of 4%. Of course, technology stocks are lower in Europe as well. And once again, the Nasdaq 100 looking set for a weaker open. Futures down 2 full percentage points after a 2.6% loss yesterday. I do want to drill down a bit more into the Asian tech sell-off specifically, though, because the Hang Seng Technology Index, with its losses in the overnight session, is now down 30% from its recent peak in February. It's now negative, actually 9% on the year. And John, of course, there already were headwinds facing some of these stocks, specifically with Chinese regulators cracking down on the financial arms of a number of big tech companies. But this inflation fear is just another overhang. And of course, that has been an overhang for high growth, richly valued stocks broadly in the equity market, and it really has spurred this rotation from growth into value we have seen this year. That's really evident when you look beneath the surface of benchmarks like the S&P 500. Your top performers in that index on a year-to-date basis, energy and financials, up 41 and 28% respectively. Compare that with information technology, up less than 4% year-to-date, John.
Kelly Lyons, thank you. Let's bring back in Robert Tibb. George Bory, still with us. George, I want your take on why we're seeing an equity market move so much lower ahead of the opening bell, and a bond market that's shrugging its shoulders here, a 10-year yield at 161. Have we lost that ability in the Treasury market to really drive lower, yields drive lower, as you get a downdraft in risk assets elsewhere?
Well, in the bond market, I think you have two countervailing forces. As we've already discussed, there are meaningful concerns about inflation, both kind of the magnitude, how much may it go up, and then how long is that going to last. But on the flip side of that, you still have sort of this ongoing, sort of rotation into bonds, which we continue to see. If you look at the fund flow data, if you look at some of the pension data, money continues to come into the bond market. But in addition to that, these are some of the best borrowing conditions we've seen in many, many years. You just look at the high yield bond market. You've had more than 60 new issuers come to market this year alone. And that's been, they've been able to achieve very favorable borrowing costs. We saw Amazon lock in very low borrowing costs earlier this week. And so, from a issuer perspective, there's pretty heavy flow from a borrowing, sort of volume impact, and so the excess cash that's in the system is getting kind of readily kind of absorbed, and the same goes for the government market as well. As we all know, there's a very heavy flow of issuance coming from the government side as well. So if you look at the bond market, there's a pretty good balance. So we like to say supply follows demand. There's pretty good demand. Supply is very high. We're not seeing meaningful signs of any indigestion, but you do get these sort of bouts of, kind of pricing, which does look sort of aggressive at times. And sometimes that gives us a little bit of pause when we think about, how to deploy money in this market.
Amazon right now in the equity market down by more than 10%. And George Bory, it's the equity piece of Amazon that's got so much attention. And I've talked about this repeatedly through the morning, Robert. In the bond market, in the credit market, Amazon just came to market and issued 2-year debt at 10 basis points over treasuries. Just how loose are things, or how tight are they, rather, in the credit market still, Robert?
Yeah, and I want to hit your first question first, and then I'm going to come to this one. The correlation opportunity in bonds, I think, is very high right now. So short term, you're seeing rates go up, and that's hurting stock prices, but that's because we're in such a dynamically strong economy. If the whole thing collapsed and you're seeing a crash in stock prices, I think you would see a big decline in yields. But in terms of Amazon, I agree with George's comment. The supply-demand situation, fixed income generally, is very good. Fund flows are very strong. Corporate borrowing is high, but overall the market appears to be in good balance, except in the front end. There's not enough supply in the front end, and the government has borrowed a spectacular amount of money, and they're going to be reducing their issuance of very short term. And you can see in the market, the bills and the twos and so on, 2-year treasuries, those yields have been very low. So that supply is tight, and availability of high quality corporate paper of all varieties is in, undersupply there. And so you see those kinds of levels.
Robert, George, stick with us. Your market gapping lower, down a little more than 2% on the NASDAQ 100, going into the opening bout 20 minutes away. The market desk with your movers. Here's Abby.
Truly an ugly morning, John. We do have that NASDAQ 100 now gapping lower and below its 100-day moving average, telling you the near-term buyers are out of the picture. The sellers are clearly moving in. So let's take a look at some of the names beneath the surface. Starting out with Tesla, down more than 7%, really a bellwether for the momentum sell-off. In addition, this company is having tensions with China. Some saying that if this turns into some sort of top, it should be called the Elon Musk top. But if we take a look at the next board, Apple is really a stock to watch. It's one of the biggest weights, of course, of the major averages. The last time that this stock put in an all-time high, it was back in January. So sometimes these sorts of sell-offs feel like they happen out of nowhere, but it's really been building for a while. The stock's down now 6 weeks in a row, but Apple, again, now down more than 10% in an official correction from that January high, taking with it Amazon, Alphabet, and Facebook. And let me remind you, these companies put up stellar quarters. Folks don't care. They are nervous about inflation. And then to round it out, we have some of the growthier, more momentum names really falling out of bed. Virgin Galactic down 19%. They put up a terrible quarter. Plus, they've delayed their schedule on top of these broader woes. Palantir, wider loss than expected. Digital Marathon Digital down 16% in sympathy with Bitcoin. Risk off, risk off, risk off, John.
Abby, thank you. It is risk off this morning for the equity market. Up next, the inflation debate heating up with Fed officials taking their positions ahead of tomorrow's CPI print. That conversation still ahead with PGIM's Robert Tibb and George Bory of Wells Fargo Asset Management. From New York, this is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
While you don't want to be preemptive, you also don't want to be so reactive that you're late. In that we have the tools to deal with these inflationary issues, but when you use them late, they can have a jarring effect. So I think that the challenge for us is to find the balance.
The Fed's Robert Kaplan weighing in on the delicate policy equilibrium. Stan Druckenmiller taking to the opinion pages of the Wall Street Journal, writing, quote, "The long-term risk from asset bubbles and fiscal dominance dwarf the short-term risk of putting the brakes on a booming economy in 22. For more on this conversation, let's bring in Mike McKee. Morning, Mike.
Good morning, John. Well, let's take a look at what Stan Druckenmiller is talking about. The Fed, lower for a very long time. They keep buying treasuries to fill out their QE requirements of $120 billion a month, $80 billion in treasuries, $40 billion in mortgages. And Stan created a chart similar to this that shows the white line there, the number of treasuries the Fed's been buying. You can see sort of in the middle, the QE 1, 2, 3. But look at how rapidly treasury purchases have risen over the past year. And then the blue line is retail sales, skyrocketing with so much in the market, so much liquidity out there. He's worried that inflation is coming. Now, the Fed's answer is inflation's going to be temporary. Why do they say that? Well, take a look at this. The PPI has been rising for intermediate goods. The the white line there is the intermediate goods. It's the stuff that goes into the things that you make, like the semiconductors that we're all missing. But the gold line, the orange line, is final demand. What's happening so far is companies are absorbing a lot of the inflation pressure out there. The question is, how long will they do that? Now, tomorrow we get a CPI number that's going to scare the pants off of anybody who's an inflationista, thanks to Barry Ritholtz for coining that term the other day. It's going to be the reaction to the big drop in the CPI we saw this same time last year. You can see the yellow line all the way over on the right-hand side. The forecast is for a year-over-year number, 3.6%. We haven't seen that since 2011. But again, that's a lot of math because of the comparisons to last year, and the Fed thinks that's about the worst of it. We shall see.
Two concerns here, inflation on the one side, asset bubbles on the other. Mike, thank you. I caught up with Bill Dudley, formerly of the New York Fed, and asked him about the Druckenmiller piece in the Wall Street Journal this morning. Take a listen to what he had to say.
You know, the Fed's view is if we tighten and the stock market goes down in some subsequent period of time, that will tighten financial conditions, and we may then not have to tighten monetary policy quite as much. But they agree that markets are frothy, but they're looking through that. They're determined to keep rates low until